are pretty low. But, we think there's not a lot of downside risk in those asset classes either, with all the fiscal support that's coming, with the economic acceleration. But there's not a lot of upside. So I think you're kind of looking at mid-single digits for a lot of the higher yielding sectors within fixed income. And I think if you're playing for upside, you really have to look to equities. And I think one of the themes that you referenced earlier in some of those comments was this idea that dividend growth and dividend-oriented stocks ought to catch a bid. Frankly, it hasn't worked very well year to date, and that part of the market has lagged. But we think it's going to you'll see that rotation transpire this year.
Michael, we'd love to get you back soon. We need a longer conversation about this, and I apologise for some of the technical problems that happen behind the scenes too. Michael Friedrichs there of BlackRock. Thank you, sir. An important conversation. Maintaining the lowest duration at any point in their flagship fund's 9-year history. Really interesting stuff. Let's get back to the markets. We pull back just a little bit with your sector price action. Here's Abby.
John, it's pretty interesting because we are well off the lows for the S&P 500. At the lows, down 0.8%. Right now, down about 0.25%. Either way, the worst day in almost 3 weeks. And if we look at the IMAP in the Bloomberg terminal, it's going to look much more risk off than it is at this point, mainly because you have so many sectors in the red, but most of them are down less than 0.4%. On the other hand, you have energy up 1.5%, so that catch-up sector from last year's big declines, plus the energy crisis right now, and oil flirting with $60 a barrel, helping out that sector. Healthcare and consumer staples, a tad defensive, but nonetheless not quite as deeply in the red as it appears. However, in case it turns into something, John, let's dig into what is not working, and that is clearly the tech sector, down about 0.8%, at the lows down 1%. And the FANG complex, those big mega cap names in particular, are down more. The chip sector is not doing so well. And then the hardware part, subsector, down 1.1%, and that has everything to do with Apple being lower, perhaps again, because Berkshire Hathaway cut their position. So some folks seem to be selling that stock, John.
Taking a bite out of last week's rally, your equity market a bit softer this Wednesday morning. We pulled back 0.25% on the S&P, on the Nasdaq, off by 0.6%. Abby, thank you. Coming up, the market moving events you need to be watching. That'll be next in our trading diary. From New York City this morning, good morning. This is Bloomberg.
CPG history, their experience, and really how we might be able to combine together to really create this fantastic public company. And so we kind of got into the SPAC thing a little bit before it became such a hot method of going public.
Markets are just really hard sometimes. Upside surprise, upside surprise, upside surprise. The data beats, and then we roll over. Down 0.25% on the S&P 500. The Nasdaq off by 0.6%. Interest rate risk seems to be the big theme for portfolio managers at the moment. Your 10-year yield taking a sneak peek of life above 130 on a US 10-year in the last 24 hours. Feels so odd to see it there. 130 handle again on a US 10-year yield. That's the story of the market. Here's your trading diary. What you need to be watching this week, over the next several days. Fed minutes out at 2 p.m. Eastern time. Before we get there, the administration's COVID response team holding a news conference at 11 a.m. President Biden discussing his stimulus plan with Labour leaders later this afternoon. Plus, after those Fed minutes tomorrow, we'll hear from Governor Brainerd as well. Before we get there, we'll get claims data and a little bit more economic data from the United States with some PMIs to close out the week on Friday. From New York City, this was the Countdown to the Open. I'm Jonathan Ferro. Follow the conversation on Twitter at Ferro TV. This is Bloomberg.
I feel we have a very good chance to not only have positive growth, but perhaps a somewhat more encouraging positive growth.
The rebound in the second and third quarter will be quite strong because the expectation is that the vaccine will help clear the way to less restrictive lockdown.
We are going to have a recovery, but it's going to be an uneven recovery.
Of course, it will have direct impact on our growth forecast, and it will be very difficult to reach 6% of growth.
You're going to get a roaring 20s type of recovery and a boom period.
We are certainly seeing ourselves towards the second quarter being in almost opening the economy as much as one can.
We should not be too quick to cut back on the expansionary fiscal policy.
We'll get there. The question is not a question of if, it's a question of more when.
This is the 1980s all over again, to make sure that we keep our hands firmly on the driving wheel.
I do not see demand coming back to the pre-COVID level anywhere earlier than the end of 2022.
If that happens and we see a demand recovery, then I think the market can absorb it.
Wednesday, the 17th of February, 3 p.m. in London, 10 a.m. in New York, 30 minutes into the U.S. trading day from London. I'm Guy Johnson. Alex Steele is over in New York. Welcome to Bloomberg Markets. Alex, just sensational data out of the U.S. economy. Stocks sell off, bonds catch a bid.
Yeah, the retail sales, furniture sales of 12%, like you're welcome. I feel like I refurnished my house and that was all on me. Okay, so let's get to the market here because Citi had a note out that talked about the 10% pullback for the S&P is actually pretty plausible, but doesn't see like a 50% bubble bursting kind of situation. So we are a little light though in the equity market, particularly in tech, as well as the small caps down 0.8%. The other thing I wanted to highlight, of course, what happens with yields. Overnight, we hit that high 1.33. We're coming off that level, but we're still 1 128 here on the 10-year. You have to ask the question, at what point does the Fed start to have a different type of conversation? We get the Fed minutes later on in the day. Also, the VIX moving higher, went below 20 yesterday for a moment. Now we're back up above 20, and the reflation trade still living in some commodities. Now we're still digesting what's happening in Texas in terms of the shortages of lots of stuff. You can't export wheat, for example. So all of that kind of roiling different areas of the commodity markets. Guy?
Well, let's get back to that data. Super strong data out of the U.S. economy this morning. Retail sales surging in January, the most in 7 months. If you're in the inflation camp, this is the kind of data that you want to see. Bloomberg's Mike McKee joins us now to work our way through the numbers. Mike.
Well, Guy, at 8:29 Wall Street time this morning, the story was the U.S. economy is slowing down and in trouble still. At 8:31, the narrative changed to, wait, what? Look at these numbers. It's not just the fact that we saw upside surprises. It's the magnitude of the surprise. 5.3% for retail sales, and the PPI comes in at 1.2%, and that's just for the month. That's not year over year. Industrial production, more than double what was forecast. So is this a new narrative? Well, not so fast. The one thing with retail sales to keep in mind is most Americans got $600 checks during January, and much of that was spent. That doesn't happen every month. And then second, seasonal adjustments. The government adjusts the numbers on a seasonal basis to take out the highs and lows, and that doesn't work when you're in the middle of a pandemic and half the country is locked down. Take a look at this. The adjusted sales were higher by the adjusted sales higher by 5.3%, unadjusted sales down 17%. So there's a 22.5% swing there by seasonal adjustment, and that really accounted for much of the retail sales change. In terms of PPI, when you look at it on a year-over-year basis, PPI up by 1.7% on the headline and 2% on the core. That's off a base effect that is very low, so it looks like more reflation than real inflation, and the PPI and CPI have not been matched up. CPI coming in disappointing last week. Now, manufacturing, the industrial production numbers are good, and they have been good, and you can see the yellow line here. We have seen a strong reflation of manufacturing since the pandemic, but we are not seeing a strong gain in manufacturing jobs. And as long as we have a lot of people who are out of work, we're not going to have the kind of shortages that would lead to inflation. So what's the takeaway here? The Fed's going to look past all of this. They know it's temporary. There are a lot of weird things going on, like the seasonal adjustment factors. The real question is what happens in Washington. Republicans could say, we don't need more stimulus because we're seeing this strong growth. Democrats can say, but a lot of people are out of work, and these are temporary factors. We'll have to see how all that plays out.
All right, Mike, really great stuff. Thank you so much. Love the dose of reality in there. Bloomberg's Michael McKee. And joining us now, Catherine Mann, Citi Global Chief Economist. Catherine, let's just pick up right where Mike left off. You could look at some of those charts, particularly anything in retail sales, and say, that's a V-shaped recovery. I don't need more stimulus.
Well, I think you got to look at a couple things. First, people are able to buy things either online or from stores, and they have the wherewithal to do that, and they're going out and buying. But I do think that when we think about where the jobs are in the economy, it's still in the services sector that still is very, very weak. In bars and restaurants, we're down in terms of the data. So we still have a very, very unbalanced recovery for the United States, and actually this is true for around the world. And until we get more balance in here, we really can't say that we're out of the woods, because balance is really important when we think about prospects for sustained growth going forward.
Let's talk about that sustained growth and the kind of growth that we're going to have, Catherine. I want to take you to Boston. Mr. Rosengren from the Fed speaking right now, talking about policy support, setting the economy up for a much stronger second half. How much stronger?
Well, I think the U.S. economy really is, if the fiscal policies come through anywhere near the size that we're talking about, the second half of the year is really going to be dramatic for the United States. But, the United States is still only part of the global economy, and especially to the extent that we see a lot of spending in the form of goods as opposed to services, there's a lot of spillover to the global economy through the trade channel. And so I think we're going to be surprised when we see some of the trade data coming in, and it's going to make the trade deficit look larger for the U.S., and that's going to be a negative when we look at some of the GDP numbers going on in the second half.
So are we justified at yields at 128, 133 on the 10-year?
Well, they've been, somewhat subdued for an extended period of time, and to expect some increase coming from both the demand side, the real side underpinnings of the economy, that makes sense. The inflation, there is going to be more inflation this year than there was last year. Nothing that's out of the ordinary, nothing that's should be a scary inflation. We're not seeing anything even above 2% sustained for the year. So the other factor, I think, that on the 10-year that we have to remember is there's a lot of foreign demand for U.S. securities, and the more the 10-year looks attractive, the more those foreigners want to buy it. And so that is a sort of a natural cap on how high the 10-year can go.
Okay, let's fold this in again. Back to Rosengren. He's speaking now. Inflation is still too low, he says. Do you think the Fed, though, may end up getting pushed around by the market? If we get up to 1.5, if this move in yields continues sort of upwards from there, is that going to force the Fed's hand?
So I think we have to question, what exactly is the Fed trying to do? I mean, it has its dual mandate, the average inflation objective now, and as well as a broad-based and inclusive objective with regards to employment. We're a long way from reaching that second objective for sure. On the first objective, we don't have sustained inflation that would achieve some sort of average inflation targeting. So the question is, what exactly in the markets would represent the type of turbulence or pushback that the Fed has to address? Are we talking about that 10% correction in the U.S. equity markets that my colleague Tobias Lefkowitz was talking about on Bloomberg earlier this morning, having written about it last night? Is that 10%? I don't think that's really much of a challenge for the Fed, given how far the markets have already incorporated multiple times good news. The interest rate concerns, as again, I think there's some moderation in the pressures on the interest rates coming from foreigners purchasing U.S. assets. And I think that that's a factor that really has been an important moderator of the market. And so it's the market, the foreigners, doing some of the work that some of the domestic people think that the Fed ought to be engaging on. So I think we have to think about this in terms of a global context, especially when we think about market moves on the U.S. Treasuries.
Question on the relationship between all of this. Is it binary? As in, like, if we get a really big stimulus, will inflation completely take off or not go anywhere? Does it have to be a binary situation that everyone is talking about?
No. I think what we really ought to be thinking about, especially if you're an investor, is thinking about granular. In other words, there are definitely going to be some sectors of the economies around the world, not just the U.S., that are going to be able to pass through some of their cost increases and have traction, have pricing power, and gain more in terms of maintaining their earnings because they're able to pass through cost increases. There are other sectors where this is not going to be the case. So if you're thinking about inflation, you really have to get down below the top line in order to take advantage of these differentials across the different sectors. And once you think about that granularity, it starts to erode any notion that there's a sustained increase in inflation, broad-based top line across all sectors, because there's so much cross currents that's happening under the hood.
Catherine, stick around. Yeah. We need to carry on this conversation. Catherine Mann, Citi's global chief economist. She's going to stay with us. We're going to get her thoughts. We're going to dig deeper into the stimulus story, the green agenda as well. That's coming up. This is Bloomberg.
let's just start with the numbers.
And it would be essentially free cash flow positive in 2021. That was sooner than people had been expecting.
We have pretty good numbers here in the biggest divisions of Morgan Stanley. They are firing on all cylinders.
We've had this huge rivalry historically between Morgan Stanley and Goldman Sachs.
There are 24 reasons for Mr. Diamond to celebrate today.
As much as people may want to focus on trading, for Bank of America, it's all about credit.
It seems the markets are very happy with Trump. They're very happy with Biden.
Start your mornings with Bloomberg Surveillance. Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Extraordinary market day.
This rally just keeps on going.
But there is a tipping point.
The business team you love to watch. Weekday mornings on Bloomberg Television.
Live from London, I'm Guy Johnson with Alex Steele in New York. This is Bloomberg Markets. So many Texans still remaining in the dark. Dangerously cold temperatures continue to leave them without power for another day. Joining us with the latest on what is happening, Simon Casey. Simon, you're not in Texas, and the reason we're talking to you is basically we can't communicate with many of the team that are based down there. Bring us up to speed with what they are hearing, though, and you're hearing intermittently from them.
Well, yeah, actually, I'm talking from the relative comforts of suburban New York. I mean, but yeah, you're absolutely right. My colleagues down in Texas are finding it very tough going, as are millions of other people down there right now. The blackout still continues to affect large parts of the state, including what looks like a lot of Houston, which is the fourth largest city in the U.S. And ERCOT, the grid operator in Texas, is showing no real signs of getting to grips yet with this problem. A huge portion of its power supply is still offline. And a lot of people, as you say, are struggling to they can't keep their homes warm. We're hearing that fuel availability is becoming an issue now across the state. As you know, the energy industry is in complete chaos. A huge chunk of oil production is offline. Gas production is down. It's spilling over into neighboring states, and we've seen rolling blackouts in other parts of the southern U.S. as well. But it's a gigantic mess, and it's still not close to being resolved yet.
Simon, we appreciate that update. Thank you very much, Bloomberg's Simon Casey. And just as Simon was speaking, ERCOT, which provides about 90% of Texas's power, the grid operator, says that they hope to reduce some outages throughout today, but they're still short about 14 gigawatts of power. They also are saying they lost some imports from other states due to Midwest power issues as well. So I want to bring back Catherine Mann from Citi. Catherine,
yeah.
To me, something that really stood out over the last, 72 hours is that we're going to have a real energy supply, infrastructure, battery storage conversation. And I wonder how you think about that conversation as it relates to stimulus, as it relates to D.C. and a green plan.
So we've been talking a lot about these two roles for fiscal policy now in the U.S. economy, and again, this is a conversation that many countries are having. The first phase of all of the fiscal efforts associated with COVID was about life preservers. In other words, maintaining people's incomes, maintaining businesses through the pandemic, so that there would be both spending power as well as businesses who spend it at the end of the pandemic. But it was always the case that at some point there had to be a pivot from life preservers to an infrastructure, green-related fiscal strategy. The green-related strategy, the infrastructure-related strategy would catalyze private sector investment, and that's the foundation for sustained growth going forward. Life preservers are good, they're necessary, they were required, but you've got to have this pivot to these longer-term sustainable underpinnings of growth. Green is one of them. Infrastructure is part of that. Different countries are moving forward to different degrees in that regard. In the U.S., there's a concern that how many times is the administration going to be able to go back to the well? That's the real concern.
Yeah, I think that's a really key point, Catherine. Would it be better to make that pivot now? The president's talking about going big. The current program is going to drive consumption. It's not going to drive investment. Should we be making that pivot earlier?
Well, it would make sense to incorporate both the objectives of enhancing job capabilities for people, income growth for individuals, as well as having a more green-oriented agenda. I mean, one strategy, of course, where you can combine these two is, of course, in mitigation and adaptation of many, many buildings that still need to have a much more green-oriented, whether it be windows, roofs, walls, et cetera. It's a very, very, it's a strategy that is growth-enabling, it's job-creating, and it's also green. So thinking about that combination is something where it's really getting, two gains at once.
I feel like we get bogged down a lot in the short-term differential between, say, Europe and the U.S. when it comes to vaccinations and the variants. And I wonder if the conversation in a year, is it going to be about the differential in the green plans and the stimulus money in relation to that? How does this play out for growth over the two continents?
Well, sort of, the Euro area had the Next Generation EU, sometimes it's called the Recovery and Resilience Fund, and that was always designed when it was originally put forward late last year, it was going to have money go out in 2022, and that is when the money's going to go out. There's a lot of reform associated with that as well. So when that was originally promulgated in Europe, it was very, very positively received by the market. It was not just that it was going to be green, that it was going to be money, but of course it was pan-European, was going to be funded by pan-European financial assets. So that looked really good. Now, of course, Europe gets bogged down in details a lot in terms of actually getting these things done. But I think what we're going to be looking at in 2022 is a very different pace of economic activity between the U.S. and Europe. And, we'll have to see then how much this green agenda really has greater footing in Europe than it does in the U.S.
Catherine, you're already beginning to see the market pricing this in, less so in the currency market, but you need to have, you've got competing trade and financial flows there, which I think is something the market's still trying to figure out. But if you look at break-evens, the difference, we're at record wides between Germany and the United States at this point. How big a growth differential are we going to see?
Well, when we look at growth differentials in a couple of different ways, most recently in the Global Economic Outlook and Strategy report that we issued last month, we started looking at standard deviation from historical experience as a way of thinking about growth differentials instead of just looking at the raw data or the raw projections on sort of GDP growth. And we're looking at the Europeans in 2022 having a standard deviation growth differential, whereas the U.S. is close to zero. So at this point, when we think about those way of thinking about growth differentials, it's a pretty big gap between where the U.S. is likely to be in 2022 and where Europe is, much favoring to Europe.
Does that lead to any central bank differentials?
This isn't a question because between now and then, according to the sort of the models that we have on the fiscal impetus that's currently in the market and so forth, and on projections, we still have inflation rates really very moderate for both economies, and so there are going to be some interesting questions about where energy prices and commodity prices might pass through relatively more in Europe than in the United States because of the tax structures being different, but also how much firms have pricing power. Once again, I talked about that in the last segment. I think it's a very important question, whether or not firms might have more pricing power in Europe than they do in the United States. That's going to make for an inflation differential as well.
Catherine, always great to catch up. Thank you very much indeed for your time today. We really appreciate it. Catherine Mann, Citi's Global Chief Economist. This is Bloomberg.
women leaders were actually better at controlling the deaths from COVID-19. Do you think out of this pandemic, we'll see more countries be willing to elect female leaders?
When we look at women leaders, we tend to project on them baggage that they shouldn't bear.
Women are given an opportunity when no one else wants to do the job.
Women had a very clear objective. They wanted to save lives.
The women leaders, if you look at their careers, have also built up a level of trust.
In fact, women have to be better at communication in order to be elected as leaders, whereas this doesn't hold true for men.
We need to get those sexist stereotypes out of our head and give women a fair run for leadership.
Trying to change the stereotypes about women is not only the business of women, but men have to be part of it.
Global markets never sleep, so stay connected with Francine Lacqua in London, Matt Miller in Berlin, and Kaylee Lines in New York. Perspective on the day ahead. Bloomberg Surveillance, Early Edition. Weekday mornings on Bloomberg Television.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
Fourth quarter 13F filings out yesterday, giving investors insight into largest hedge funds and how they're positioned before, like a couple months ago, but still want to find out what's in them. Bloomberg Chanel Basic is digging through them. Let's give us the themes, because that's what we were going to care about, right?
Yeah, absolutely. And first you have to look at the type of investor, Alex. You have a pension fund, for example. The hundreds of pension funds that have filed are showing that they're net sellers of technology stocks. That is interesting because we know that everybody else is buying them. So why is that? It's probably because they're also exposed to hedge funds. It's probably because they're leaning conservative. We saw pension funds pile into financial stocks, for example. That should tell you something. Hedge funds, on the other hand, were net sellers of almost everything else. So hedge funds were net buyers of technology stocks, the big names that you could think of. Some of this, Alex, is by pure market cap, right? Apple, Microsoft, they all had diverging opinions, as you know, with Warren Buffett and Apple. We did see a bunch of the Tiger Cubs, which we love to follow, right? We know that they're big technology buyers, both in public markets and private markets. Tiger Cub really betting on Microsoft there. So while Coatue had bet on Walt Disney. So that shows you, again, as you said, where they had been going. It is backward leaning, but at least shows you thematically the direction that they're heading in.
I'm trying to understand the logic behind why they may be making this trade. Is it a defensive move because everybody else is selling, they're buying, they think the market may get over its skis and this could be a good place to hang out? Is it because they think that actually the numbers are going to come through strong? I'm wondering what the motivation is, Shonali.
It's a great question, Guy, because again, I think some of it is just by pure market cap. When you buy into these names, you're not buying little amounts. But if you look at some of the big net sells for the hedge funds, Zoom was one of them. So you're not seeing net buys across the entire technology industry. You are seeing people pair off a little bit when it comes to some of the high-flying names rather than the big, to your point, defensive, big, steady, stable, big tech names. To your point, defensive, big, steady, stable, big tech names. The stay-at-home trade with the Zoom thing I thought was really interesting because it shows that some of that has probably run its course, and to your point, defensive is a bit of the name of the game here.
Let's dive into the GameStop hearings tomorrow, because I wonder what kind of different disclosures we may see in the future.
That's a beautiful question.
Thank you. Shonali can come back anytime.
Well, there's two major hedge fund managers being taken to Washington, D.C., and it has nothing to do with the crisis we just lived last year, right? As far as GameStop goes, short selling, and it's not just about the hedge funds, right? We know gamification and Robinhood will be questioned, but short selling is something that seems to be a reasonable and simple to understand place for politicians and regulators to look at.
How do you think they're going to go after these guys? What are the key questions that we should be watching out for? What does the industry need to get out of tomorrow?
Well, one of the interesting things, Guy, is Ken Griffin's presence at this hearing. Why? Because, as we know, Citadel had put money towards that Melvin Capital, liquidity boost, and then they also have Ken Griffin is the majority owner of Citadel Securities. I would imagine that that relationship is a little difficult for most people to understand, that you are running a hedge fund, but you're the majority owner of one of the largest market makers in the world. So that parsing out those distinctions and the kinds of conversations or lack thereof of Robinhood will be a main question.
Excellent. Shanali, thanks very much indeed. Shanali Basak joining us ahead of those key earnings. The 13Fs obviously will continue to flood in, and we'll keep you up to speed with what's happening. Some great coverage happening on the terminal as well. Up next, we're going to be discussing what is happening with the IPO story. We talked about SPACs yesterday. Today, we're going to be talking about the relationship between SPACs and the IPO market. SPACs are already halfway to the level we reached last year in terms of the numbers of those happening. Jason Thomas, Carlisle's head of global research, is going to be joining us to talk about this next. This is Bloomberg.
I think what we've seen during this period of time is that communicating via video is not a fad. We are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
Trading revenues coming in better than expected. Everything cash, $1.4 trillion of cash. One of the most notable aspects of this report that was stellar.
Live from New York, I'm Alex Steele, Guy Johnson in London. This is Bloomberg Markets. Hey, Guy, I have a fun chart for you. It's about SPACs. They are on pace for a banner year, and I say banner, but really it's kind of amazing. So capital raised through SPACs actually reached $42 billion. That's about half of 2020's volume, and that's just as of February 11th. Of course, SPACs are special purpose acquisition vehicles. They're usually associated with one big name in the industry. They go out, they raise money, then they go make the acquisition. It's kind of like an IPO, but with a lot less of the marketing and disclosures. Now, Guy, the question always is like the key man risk thing, because you're associated usually with someone pretty fancy in different industries, and then what happens if it's just a wrong call or disappoints or they go somewhere else?
Yeah, the hope is that that doesn't happen. Somebody pretty fancy. Well, Ken Moelis is somebody pretty fancy, and he's certainly getting pretty engaged with all of this. Of course, the Moelis and Company CEO and chair. He was talking to us yesterday about the relationship between SPACs and IPOs.
For many decades now, money has been pouring into alternatives. I think there's $4 trillion in private equity, $1.5 trillion to be spent. And what have they had all this time? They've had the ability to sit down with a company, look at their projections, get to see what the inside of a company and what their future looks like. By the way, same with late stage working capital, which has diverted many companies from going public. In fact, over the last 20 years, I think there's 50% less stocks trading publicly than there were 20 years ago as a result of those pools of capital. So with the SPAC market, it's probably up to $350 billion. Today, it's just another pool of capital trying to find great opportunities for high growth companies and getting the benefit of due diligence and meeting with the company in advance. So I think it's very exciting.
Well, speaking of due diligence, right, you have Moelis and Company, you have a whole slate of bankers. Bring us into the process a little bit here, because if somebody doesn't have that kind of capability, how hard is it to get a deal done? And I know you're looking at another deal right now for your other SPAC, right, Atlas 2.
Well, I don't know how you know that, but you might have better sources than me, Sonali.
Well, you have to, right? You have to get the deal done within a matter of time. Is it hard to do for just anybody?
Well, look, I think it's hard to do good deals. And what we're viewing this as is really an alternative, a parallel to what I consider an old method of going public. I went public, it's coming on 6 years now. And it took me 12 months. From the time I said to my organization, let's go public, it was a 12-month process. And it was very nerve-wracking. You have your whole organization ready to go, and you don't know what the outcome is till the final day. Something could happen in the market. The brilliance of what's going on with this new method of SPAC is that in a very short period of time, an entrepreneur has certainty. And I will tell you, high growth companies, entrepreneurs, certainty and knowledge of where your company's going is very valuable, and they're willing to pay for it. And so what we're trying to do, we're really trying to find disruptive companies who are alternative really to IPOs. We don't view it as a special purpose acquisition company. It should be named a special purpose IPO vehicle. And I think we're in a wonderful position to assess. We have 900 people around the world to assess who are the best companies in the world, who are the best partners, do the diligence, introduce them to the best investors in the world. I think I'm very excited about what this might lead to for going forward.
That was Ken Moelis, Moelis & Company CEO, speaking to us yesterday. And Guy, what's pretty funny is that you get a ton of these SPACs, right? And they all have these creative names. Well, one was filed on Tuesday, and the name, Just Another Acquisition Corp. They want to raise $60 million for an acquisition in an unspecified sector. Basically, like, just give me some money. We'll see what happens.
Yeah, have you seen what ticker it's going to trade under?
No, which one?
Jack.
Jack. That is awesome. That's pretty brilliant. You have to wonder at some point, like, when is there actual fraud? Because not all SPACs work out. Just look what happened in the oil patch a couple years ago when SPACs were super hot. Really key man risk, really hot ones didn't fly.
Absolutely. And then you've got to think about also the fact that there are potentially a limited number of targets out there. That's going to be a factor as well. And also just the way that it's weighted, some would argue, in favor of the early investors, and whether or not that is something that everybody fully understands, where they invest in the second phase as the SPAC rolls out and delivers its target.
Right, exactly. There's two investing opportunities in that sense. Okay, let's go to the broader sense then. Are SPACs basically special purpose IPOs, as Ken Moelis said? Well, Carlyle Group looked at the trends in the IPO market in a new report, and we want to dig into that with Jason Thomas, Carlyle Group Managing Director and Head of Global Research. Jason, it was a great report that really dug into the IPO landscape, and I wonder how you think about the SPAC world within the IPO world.
Well, over the last 20 years, there's been a 75% decline in IPOs of operating companies. And I think that's really very much related to the change, the economic transition from the industrial to the digital age. Today, the investment and the assets of younger, faster growing businesses are almost entirely intangible, that it's proprietary technology, software, algorithms, business methods. And these assets are very hard to value, but very easy to steal. And so for these businesses, rather than go public and have the disclosures where you explain how your technology works, you explain the market you're seeking to disrupt, it's much more efficient to rationally track that capital confidentially through non-disclosure agreements in private markets, and then put off that listing until you've attained the requisite scale, user base, or brand identification. So that's the underlying economic phenomena that we're observing, and SPACs in many ways is a response to this.
Jason, I just want to come back to this bit about stealing of IP, because I think it is significant. As you say, many companies, that is where the value lies. Are you suggesting that the regulatory reporting requirements of being a public company basically allow the theft of IP?
I think in many cases, what you're looking at from the public, when you invest in a business, you need to understand how the business works, how the technology works. So it's not simply what's mandated or what's required by regulators to disclose. It's that you have to, you can claim that you're going to grow your free cash flow at 20% per year, but you have to explain how that is going to happen. And so those disclosures to the public, as soon as you tell one investor in a public context, you have to tell every investor. And it's that nature of a disclosure regime that allows for these ideas to be disseminated very broadly. And I think when your basic idea is a business method, or it's a way of arranging between buyers and sellers, disintermediating existing markets, those are the sorts of ideas that competitors or would-be competitors can very quickly expropriate. And so I think that's the challenge that is facing so many businesses today that are effectively digital platforms. And again, it's a main reason why there's been this extraordinary growth in private markets as opposed to public.
Right, so let's get to that. You have a great chart in your piece that looks at GDP and then the number of public companies. And as GDP kind of jumps higher, the number of public companies just kind of falls off a cliff. Is that a story about the private markets? Like, what's the reason for that?
I think it's, again, this transition from industrial to digital age. In the industrial age, growth depended on physical assets, property, plant, equipment, inventories, distribution networks. Those assets are really very easy to value. You know, the cost basis that you report on your balance sheet for your factory or the industrial equipment that you own is actually a pretty good reflection of its market value. And in fact, for 60 years, trading strategies focused on value generally found that the difference between the market value of a company and its book value was a very strong predictor of its returns. That has ceased to be the case over the last 12 years as intangible assets have accounted for a larger share of company value, because those intangible assets are not reported on balance sheet. If it's an internally generated intangible asset, it's not reflected. So now book value is no longer a statistic that really has any meaning for stock market investors.
Jason,
that's the main change.
One of the things I thought about when I looked at that chart was I wondered whether or not this was also big tech just hoovering up everything that could have potentially been a competitor to it at that point, and whether this is an argument actually against big tech and maybe some kind of restrictions around their ability to make acquisitions.
You know, I think that's an interesting question. But when you look at the 52% decline in the number of public companies, you see that it's actually, you think of it as births and deaths. So births are IPOs, deaths are essentially acquisitions. And it's actually the decline in IPOs, the decline in births of public companies is the main driver of the decline. So it's no question that acquisitions are playing a role
Jason,
here, but it's the decline in IPOs that's the bigger issue.
But Jason, these companies are being bought early stage. They're not being bought, and many of these companies, certainly a few years back, were bought early stage. They never got to the point at which they were big enough to IPO, or certainly would be thinking about it. The big tech companies, they went in and they saw the opportunity, they bought these businesses. They never got to the IPO stage.
That's true. When you look at the total number of companies, though, operating businesses today, it continues to grow at about 2% per year. So we're up to now about 21,000 companies, over 100 employees. That's up from 17,000 really 12 years ago. So again, I understand your point. It's a good one, and I think it's something worthy of further investigation. But the number of these digital platforms has actually grown in absolute terms. So even if there is these early stage acquisitions of this technology, it still doesn't explain the overall decline.
What about on a regional basis? You're able to look at the data from, say, China, Europe, all rest of Asia, and the U.S. Like, does it matter what region we're talking about that shows the availability of IPOs? You have to compare between 2020 and 2015.
Yeah, I think that it's not surprising when you look at technology, biotechnology, healthcare, et cetera. These are, of course, the platforms that are demonstrating the fastest growth. And they do tend to be concentrated in the US and China. So just as when you look at the top 20 internet companies by revenue or market cap, they tend to be, again, dominated by the US and China. That's increasingly the case as it relates to these growth companies and unicorns as well. So really over the last 5 years, there was a growth in China of these private companies, startups with valuations in excess of $1 billion. There was a 5.5-fold increase in the number of these businesses. It's the same dynamics, lots of access to capital, staying private. And I think that we see it all over the world. But again, it's really those two markets that are the top two. And I would say what I think is most fascinating to me is how big the liquidity premium continues to be. It wasn't so long ago that people were worried about a bubble in private markets as they saw revenues, they saw market cap at 7 times revenues. Well, on average, if we look last year, these businesses, when they went public in the US and then the star market in Shanghai, they would trade up about 2x. So their offer price had a valuation that was 2 times their last private valuation. And then in the following week, they would trade up by another 40 to 70%. So, really extraordinary demand for these IPOs. And I think it also just reflects the cumulative decline in issuance over the last several years.
Just simply the availability of companies to buy. It's an interesting point. Jason, thank you very much indeed for your time today. Really appreciate it. Jason Thomas, Carlyle Group, Head of Global Research. Wells Fargo spiking higher over the last few minutes. Breaking news from Bloomberg, the company winning Fed acceptance for the sharp overhaul plan. This is, of course, related to the cap, which limits the company's ability to grow. The cap's not gone yet. That could be some time away, but a big win. And as you can see, the market reacting strongly too. We'll have details to follow. This is Bloomberg.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
Hi, I'm David Weston. Bloomberg Television is reinventing one of the most iconic brands in financial television for a new audience. Join me to see the news program for the clever investor. This is Bloomberg Wall Street Week.
"45 minutes past the hour." Alex, it's been a 3-year quest for Wells Fargo. The Fed finally giving it's okay for Wells Fargo's overhaul plan. Shares now at their highest since March of last year. To try and kind of get an assessment of what this means and kind of how long it's going to take to get rid of the cap, Sonali Basak, Bloomberg's Wall Street correspondent, Alison Williams, Bloomberg Intelligence senior banks analyst, joining us on the line as well. Alison, let me start with you. This is a huge step forward in Wells's ability to remove the cap that the Fed imposed in terms of limiting its size and ability to grow. I kind of just give us a sense of how significant this moment is.
I think, the key for investors is that we finally have, a concrete, positive step in the right direction. If you think about how long this has gone on for, it's almost 4 years to the day. So it was February of 2017, I believe, when the cap was put on. Initially, we thought it was only going to be, or management said they thought it was only going to be, a several-month issue. They kept pushing it out, and then they gave up on providing any timeline. When we look over the progress of the last year, I mean, in 2020, I think they really did address some of the biggest outstanding items that the regulators and even politicians had with the bank in terms of, they basically completely turned over the board. They brought in outside management. The outside CEO was a big deal. They brought in, basically, they've turned over almost all of senior management, a lot from the outside. And the news today is that the plan that they submitted, which really relates to risk management, et cetera, received approval. So it's not going to happen overnight. I think a lot of people, including Nathan Dean, who's our regulatory analyst that follows this issue for BI, had said, this could happen, at the end of this year, early next year. The timing in the news article, the Bloomberg News article, and some of the people that they cite seems it's consistent with that timing. But what's important about today is at least we have a positive step. So I think at least some support for that glide path.
Hey, Alex, one of the things, too, think about it. Allison mentioned 4 years.
Yeah, it's a long time.
Of this asset cap. Bloomberg's Hannah Levitt, who broke this story, had also calculated what that meant in profits. It's more than $4 billion in profits over the last couple of years that Wells Fargo has missed out on. Wow. And so it translates into real money. The real question now is they're playing catch up. They're playing catch up when it comes to their other rivals in commercial banking. Obviously, we know Charlie Scharf, who was taking over the bank, is also focusing on investment banking. Again, they have to catch up. He has his team in place now. Can they execute? And, I'm wondering, does it remind you of the Deutsche Bank turnaround story a little bit in some ways?
Does it, Allison?
I guess the parallel could be that they both have been sort of a long slog, but I think in many ways there are some key differences. I think for Wells Fargo, there's no change to the basic business of the bank. And I think that they were competitive in that business, but both banks did have some sizable lapses in terms of risk management. I think, for Wells Fargo, aside from the numbers that Sonali said that they missed out on the past several years, I think for them it's sort of an opportunity miss in terms of, the huge deposit growth that we've had this year is something that they missed out on that doesn't necessarily add to earnings today, but for the next several years. And does this somehow make them less competitive in the market? For Deutsche Bank, it's similar in the sense that trying to fix their problems also makes them less competitive. But I think that there are some challenges there just in terms of they've really had to make a lot of changes to the overall actual business lines that they're in.
Okay, Alison. Sonali, you bring up that number. It's certainly a very big one. the market knows that this company has lost out and lost out in a big way. My question is the news today ahead of schedule? We've been waiting for a long time and the story had gone very quiet. But was this something that we were starting to expect around now? Because I'm really surprised that the market has reacted in the way that it is. That's quite a big jump.
Listen,
in Wells' share price.
Yeah, only a couple weeks ago. It was just a couple weeks ago that they were reporting earnings, and analysts, Guy, how many times can an analyst ask the same question? When can you get past this asset cap? The Federal Reserve really showed here that they can impose a penalty that is so damaging to a bank, it has scared the rest of the industry for a similar type of fine. So it is something that Wall Street was clamoring for, waiting for, wondering, because until this is over, until they can get past this, Wells Fargo cannot move forward no matter what Charlie Sharp does. So did it come ahead of expected? Again, we still have to see when they're finally over the asset cap here. Will it be the end of this year? Will it be into next year? And how far? But it is a humongous hurdle.
So, okay, let's just pretend that the next year's done. As we all, I'm sure, all would wish that to be. Well, and you mentioned sort of growing in the investment banking part of its business, but like they're way behind. I mean, the behemoths of the industry. Like, if they're able to spend cash again to really grow, like, where's the realistic place where they do that that's actually going to pay off in the short term?
Yeah, it's a great question. Once you lift the asset cap, what does it mean in terms of the risk you can take on? Can they start lending to big corporate clients again, as well as the rest of America? Can they really lead with their balance sheet when it comes to deals, right? Yeah. You know, Charlie Sharp was over at JP Morgan well before he was at Visa, so he knows what that business looks like. He knows what that strategy looks like. If the asset cap is lifted by next year, that option is available to him again. Of course, you have to manage risk and, you know, extending your balance sheet. But Wells Fargo, with the idea of taking on risk again, is something he could maybe look forward to sometime in the future.
Definitely to manage that risk. The stock up now by over 7%. Shonali, thanks a lot. Bloomberg, Shonali Bassick, and Allison Williams of Bloomberg Intelligence. Thank you both very much. This is Bloomberg.
Very good chance to not only have positive growth, but perhaps a somewhat more encouraging positive growth.
The rebound in the second and third quarter will be quite strong because the expectation is that the vaccine will help clear the way to less restrictive lockdown.
We are going to have a recovery, but it's going to be an uneven recovery.
Of course, it will have direct impact on our growth forecast. And it will be very difficult to reach 6% of growth.
You're going to get a roaring 20s type of recovery and a boom period.
We are certainly seeing ourselves towards the second quarter being in almost opening the economy as much as one can.
We should not be too quick to cut back on the expansionary fiscal policy.
We'll get there. The question is not a question of if, it's a question of more when.
Valuations, particularly, sort of the technology landscape, have gotten to some pretty extraordinary levels. So I think it's not a surprise. I don't think it's any indication of the beginning of the end, but I do think markets don't like uncertainty.
Well, something else I'm keeping my eye on, guys. So we learned that New York City is short about 35,000 vaccines, and part of that is due towards the weather, so they may have to cancel some of those appointments. It's okay here, but we're going to get hit with a storm tomorrow. Also, Guy, we also had issues maybe getting in the vaccines from areas that were already hard hit by this Arctic freeze that's coming that just really decimated Texas. So another hurdle in sort of just getting everything out fast.
Yeah, it just makes you realize how connected everything is, even within the United States, Alex. It's fascinating to see what's happening. The cold weather that we've been talking about hitting Texas so hard, also just impacting a whole bunch of things. You've, of course, been following what's been happening with the energy story, but there's also chip shortages beginning to emerge. Samsung's got a fabrication plant that is being affected by the cold weather down there. So all of this story kind of coming together is just, even within the United States, just once again highlighting the complexity of supply chains and how fragile they are once they start to be hit by these environmental factors that could become more frequent.
You definitely have the makings of a weatherman with that. The map, the blue.
The cold weather's coming down here, looking pretty cold in New York. DC
the storm
looks
is
pretty chilly
through.
as well. Florida looks quite nice. I'd like to point out that Florida is looking pretty good right now. But as you pointed out, there are other issues that maybe we've got to factor in there. But yeah, it looks nice and warm. But the polar vortex coming down from the south, yes, I can definitely do the whole weather thing.
Good job. No, I think you're good. The Arctic freeze there thing. Okay, and I think we'll talk about that as well in terms of the vaccination programs, U.S. versus Europe, and kind of the growth differentials that we'll have to see coming out of this as well.
Yeah, Jane Foley's going to be coming up. She's going to be joining us from Rabobank to give us her take. She'll give us an FX perspective on all of this. That's coming up next. This is Bloomberg.
These solar arrays that we're going to install are going to be about half the size of the existing solar arrays that we have on the International Space Station. But because of the advances in technology over the years, they're going to provide about twice the power in just half of the area that the existing solar arrays cover.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Trading revenues coming in better than expected. Everything cash, $1.4 trillion of cash. One of the most notable aspects of this report that was stellar.
From London, I'm Guy Johnson. Alex Steele is over in New York. We're now counting you down to the European close right here on Bloomberg Markets. So what do you need to know out of Europe this hour? Well, the EU tripling its order of Moderna's vaccine is securing an additional 200 million extra doses from Pfizer-BioNTech, and it's seeing production at AstraZeneca's facility in Belgium drastically increase. But the region's recovery remains far behind, and we've seen that in the data today, with break-even inflation rates, a proxy widening to a record with the United States. For the love of Italy, Prime Minister Draghi lays out a far-reaching political plan for his country and Europe, saying a common EU budget is required to put this region back on track. And Ford pledges to be all-electric in Europe by 2030, becoming the largest manufacturer to commit to that target. This as January car sales collapse in the region to a record low. Let's talk about the market. Stocks on offer despite that amazingly strong US data we've seen today. We are, though, seeing the dollar clawing back gains. Remember, bonds are bid today, but we're back, and we've been tracking lower throughout the day on euro dollar. Back having a look potentially at 120 again, Alex.
I want to drill down a little bit here into the U.S. because we got some really excellent economic data from retail sales, a higher PPI, industrial production, all better. Overall, the indices, though, pretty lackluster. Some areas where we are seeing strength is the energy index up by 0.8%. That's an oil story, although many saying that oil is getting bid a little bit too much. The demand we're going to lose from Texas is going to really outstrip the supply losses. So that, watch that as we go. 10-year yield, you mentioned you're seeing some buying come in, so yields come down 3 basis points, but we did hit 133 overnight, surpassing that March high. And what that's also doing is leading to a lot of volatility in the bond market. So this is the Merrill Lynch Move Index. It tracks volatility within bonds. We've seen stock volatility moderate around 22, but are we seeing that volatility spread to other asset classes? That a big question. And I did want to highlight the high yield bond market. So overall yields are down. We know that 315 basis points, but for the double Bs in the high yield market, we're now a sub 3. Guy, double Bs, sub 3. You pointed this out. I read more about it. It is really unbelievable, and it could go even lower.
Yeah, it's amazing. You're seeing high yield just continuing to compress and compress and compress. It's going to be fascinating to see how much more there is in that trade. We keep being told there's more still to come. Let's get back to the COVID story. Let's get back to Europe's vaccination program, getting a much-needed boost. The European Commission says it secured hundreds of millions of additional shots, and it's now vowing to accelerate the clearance of vaccines targeting new variants.
The increased spread of the new COVID-19 variants, first identified in the United Kingdom, South Africa and Brazil, are a potential paradigm shift in the global fight against COVID-19. We need to further upscale mass production of new vaccines, but also of existing vaccines.
European Commission President Ursula von der Leyen speaking in Brussels a little earlier today. Just kind of think about this, though. This is Europe is in some ways so far behind that it's starting to have a meaningful impact in terms of the way that the market is pricing in recovery and a return of inflation. Let's just take a look at this chart. Europe being left in the dust by the United States, and the data today really just kind of speaking to that reflationary frenzy we're seeing across the Atlantic. So this is a market proxy for inflation, and the US very much outpacing what is happening in the euro area, the most in over a decade. The question for Europe, will this historic divergence help deepen what already looks like becoming a double-dip recession here in Europe? So this is break-evens, basically, and as you can see, they continue, that spread continues to track lower and lower. Joining us now from London is Jane Foley. She's the head of FX strategy at Rabobank. Jane, we've got a 120.30 on euro dollar at the moment. The data out of the States is absolutely sensational. Europe is struggling to catch up. Do you think the euro actually even deserves to be at 120 in the near term?
Well, I mean, I have been looking for 120 again, but to be honest, even though I say that, I think the euro has had some good news as well. I mean, we do, after all, now have a Draghi at the helm of Italian politics, and that certainly is something which the European markets will welcome. And yes, the vaccine news that we've had today from Europe, ordering more vaccinations, perhaps it's a little bit late, but it is good news after all. And we have had Germany announce earlier in the week that it will be opening up after some of those restrictions. And of course, some of those numbers numbers with respect to the COVID cases, for instance, in many of the European countries, they're not as bad as the numbers we have presently in the UK either, which has a much more rolled out vaccination program. So it isn't all bad, but I do think that we are going to have this battle with euro-dollar going on for quite some while. We're not going to have the trend that we had last year of continuous dollar strength, dollar weakness, euro strength. I don't think that's going to happen. So I think we're going to be in a much tighter range. I think it will be, quite hard work perhaps to get to 123 in the months ahead. But I think there's a reasonable chance that we will see that level.
I just want to break down a little bit of what you said, because is it the U.S. pulling Europe up with it, or is Europe has its own reflation story on an absolute level, not on a relative basis level?
I think it does have his own story. I mean, for instance, if we go back before the pandemic, if we go back to 2019, for instance,
I don't remember 2019, Jane.
It does seem a long time ago. But there was talk back then of this Japanification of the Eurozone market. And I think we've got to bear that in mind. So economists were thinking about this Europe, which was bogged down by lack of structural reform, maybe by the aging demographics, maybe by a more sluggish employment labor market than in the US, and potentially getting a situation where we would have years ahead of relatively slow growth, perhaps, and certainly sluggish wage growth. Now, those factors, or the fact that perhaps we needed more reform in Europe, haven't gone away. There's always perhaps the potential for the US to be able to reflate more easily, perhaps because of its more flexible labor market. And I think these parameters are coming back to play now. But, that said, we can talk down some of the strength in the US data today. We can look at the retail sales and say, well, look, we know that in December there were relief payments out. So clearly that was going to be spent. Clearly that's one of the reasons why retail sales was so strong, and maybe it won't be so strong in the following months, and maybe the Fed will look through that. We can make these arguments, and they have a lot of validity. It will take some months though to really clear up this picture.
Jane, I talk to a lot of people about the dollar, and there seems to be competing narratives around it, understandably. There seems to be this view that stimulus in the States will drag in a lot of imports, and that will be dollar negative. But the stimulus effect on the US economy will be positive from a financial flow point of view, because, as you say, the US may recover a little earlier. It's likely, therefore, to see a little bit more inflation, and that's going to be positive for the dollar. How do you see these competing factors working and evening out?
Well, I think it depends against, which currency, which country you're talking about. So, for instance, if we do get a better US economy, I still think that is going to be a positive, really, for high risk. So I still think that will be a good outlook for many emerging market assets, for instance. I think perhaps you're looking at it, or you have to look at it a little bit differently if you're comparing the dollar to maybe some other G10 countries where you don't get necessarily, such a big yield differential. And particularly, what does that mean against the euro? So, for instance, you could have a position where the dollar is still weakening against various high yields, but the euro is really struggling to follow that sort of tone. So for me, I think you will have a decent outlook for high yielding EM assets if the dollar is reflating, or if the US is reflating. But I don't think it's going to be plain sailing for euro dollar. I think it's going to be choppy in a far tighter range than the one that we saw last year.
So what happens, though, if the rise in yields that we've seen sort of starts to bring forward a rate hike expectations within the market? Not that the Fed will do it, but the market's going to kind of push that narrative.
Well, again, that's interesting, because even if the market's going to be starting to assume that, it's not going to assume that the Fed will be the first G10 central bank to hike. So, for instance, I think right now the market is thinking, well, maybe the Norway would go, the Norges Bank would go this year, maybe Australia, maybe Sweden, maybe New Zealand. So that narrative is going to be out there with respect to other G10 countries, but it's probably not going to be out there with respect to the ECB. That's certainly going to be a central bank that's perceived as going to lag on the interest rate hike front. So again, you have a different narrative potentially with respect to the dollar and some of those smaller currencies than you would with euro dollar. And I think that is a concept that's already entering into many investors' minds, even though the Fed will be pushing back on it. It's still going to be a narrative which is going to be there. And it is something which is likely to give the dollar underlying support. And again, that's one reason why I don't think that euro dollar can really manage this uptrend, which many people assumed would carry on happening at the end of last year.
Jane, I want to talk a little bit about what is happening with the pound, but we're still 138.45, and the pound has had an incredible run over the last few weeks. Dave Ramsden's talking right now. He's addressing the issue of whether or not the bank could maybe pull back a little bit on its QE program. But we've also got Boris Johnson coming up next Monday. How pivotal will what Boris Johnson has to say next Monday in terms of reopening the economy be to the pound's trajectory from here? If he's talking about a positive picture, do you think we could get through 140?
Well, I think that's quite possible. Obviously, it depends on the outlook for the US dollar too. But what we've seen, certainly in the rhetoric and in the press, in the UK press today, is perhaps signals that he's not going to be as positive as many people are assuming. So, you know, one of the big props for the pound this year has been that vaccine trade, the fact that the UK is quite advanced in that rollout. And that, of course, has gone alongside perhaps the more hawkish tone of the Bank of England and, of course, the Brexit trade deal at the end of last year. So the vaccine trade is certainly part of the reason for sterling strength. And what we've seen today is suggestions that they may not be so hasty in rolling back these restrictions, because if they do, we may see another push higher in cases perhaps in July. And certainly if they roll out the reopening of the schools in March, well, that might mean that the number of cases, or the pace at which cases are falling, may start to slacken. So from that point of view, it could be that the market's a little bit disappointed next year. And that, I think, is a hurdle for sterling, as well as the fact that we've got these Scottish elections in May, and that could just unleash a lot of speculation about an independence vote as well.
Jane, stick around. We need to talk more about what is happening here in Europe in a little bit more detail. We've already addressed some of it. We'll talk more about what Mario Draghi is going to deliver. Jane Foley joining us from Rabobank. Draghi talking about rebuilding the Italian economy and the European economy as well. That's coming up next. This is Bloomberg.
Women leaders were actually better at controlling the deaths from COVID-19. Do you think out of this pandemic, we'll see more countries be willing to elect female leaders?
When we look at women leaders, we tend to project on them baggage that they shouldn't bear.
Women are given an opportunity when no one else wants to do the job.
Women had a very clear objective. They wanted to save lives.
The women leaders, if you look at their careers, have also built up a level of trust.
In fact, women have to be better at communication in order to be elected as leaders, whereas this doesn't hold true for men.
We need to get those sexist stereotypes out of our head and give women a fair run for leadership.
Trying to change the stereotypes about women is not only the business of women, but men have to be part of it.
Our generation's biggest problem.
Climate change is happening.
And the world's most innovative solutions.
Transport, industry, buildings, electricity, all of those things.
Everything you need to know about our changing environment, the politics of global warming.
We can and we will deal with climate change.
In the fight against climate change, Bloomberg Green has you covered.
Sostenere questo governo.
Supporting this government means supporting the choice and irreversibility of the euro.
Sempre più integrata.
And a more integrated European Union that will bring about a common budget to combat member states' recessions in this difficult time.
Mario Draghi delivering his first speech as Prime Minister before the Italian Senate earlier today. He called on his fellow Italians to pull together to rebuild their country, comparing the task of the post-war reconstruction effort. Still with us, Jane Foley, Head of FX Strategy at Rabobank. Jane, let's just deal with the issue of Draghi's desire to see an EU budget. What I'm being told from Brussels is that the Next Generation funds need to be spent wisely, they need to be delivered, and they need to have a meaningful effect. Then maybe the conversation about a continuation can happen. The Hamiltonian moment doesn't seem to be kind of quite there yet. We haven't crossed the Rubicon on this. Do you think Draghi is the guy to drive Europe forward on this, though? Do you think he has the capability maybe to convince those in Germany and the Netherlands and Finland, etc., to actually deliver upon this?
Well, I can't think anyone else who could potentially do the job better, but that doesn't mean to say that he will get the job done. Now, clearly, you know, with Macron, he perhaps is going to give a little bit more impetus to Europe. They are, after all, losing Merkel in the summer. So we will have these key politicians driving Europe together. But we saw last year when the recovery fund was put together, there was a lot of resistance, particularly from the Frugal Four. I don't think that there is the appetite amongst the Frugal Four to really shift on their position right now. So there is a lot of work to be done in terms of achieving a common budget. If it can be achieved, I think this is going to be a slow and painful process probably for Europe, and I don't think it's going to be quick. Now, there are going to be elections in Italy perhaps in around about 2 years' time, or at least that's the latest I think that they can be held in June 23. If Draghi gets that far, you know, I can't see that he will have made an awful lot of progress, but you know, he is perhaps the only person that could potentially offer some hope on this front right now.
So what if he can't do it? What happens?
Well, you know, first of all, I mean, like the Europeans have said, the first thing that he needs to do is spend the recovery fund money wisely. Now, it was about the spending of this that created the real friction within the previous government anyway. And one big real question for everybody, but particularly I think Italy, is can he invest this wisely in productive resources? We've seen very little growth in Italy, you know, for years, and there is a very low productivity issue. So he needs to show that can be spent wisely. He needs to get the political support to do that. That in itself is going to be tough for Italy. I mean, they've had decades and decades of really difficult politics here. So he's got a real uphill battle. If he can do that successfully, maybe he can win over, you know, a few brownie points from the Dutch and from the other Frugal Four team players. But I think this is going to be tough.
Let's talk a little bit about what is happening with BTPs and then talk a little bit about Christine Lagarde, Draghi's successor, Jane. Yields have been compressing with bunds. We've seen obviously a huge bid in BTPs, and Draghi is driving that. Nevertheless, we are starting to see yields rising everywhere, and there is going to be a gravitational effect off the US 10-year that is even going to reach down into Italy. Do you think that the ECB is going to respond to that? Lagarde in the past has been famous for saying our job is not to manage spreads. That clearly has changed. If we see yields starting to rise globally, will the ECB lean in on that?
I think now, yes, I think they will. You know, I think they need to see better signs of growth before they really pull away from that position. But I don't think that's going to be an uncommon attitude. I think the majority of G10 central banks have retained that very cautious position. We've seen it from the Fed, we've seen it from the Australians, we've seen it from the Swedish, for instance. And some of these economies, certainly Australia, Sweden, have been doing a lot better than the Eurozone. So I think we will see Lagarde wanting to lean in. Clearly, you know, when she decides not to do that, it will be because the economic data is looking far brighter and we're through this pandemic. But I think it's too early just yet to expect her to step away from that.
I just wonder how the timing of all of this, like how much time is the market going to give Draghi to get it together? How much time will the market give the ECB the leeway to keep doing what they're doing? How much time until budget deficits start to become the conversation? What are we looking at here?
Well, quite possibly the second half of this year. I think in terms of budget deficits, as soon as we see better signs of growth, budget deficits will become, you know, a bigger part of the conversation. And then, of course, budget deficits become more of a concern if interest rates are going high, because suddenly that's more expensive to fund. So I think all of these things are going to come together once we have more established and more confident economic recoveries. Maybe that will be the latter half of the year. I don't think it's going to be the first half of this year. Perhaps it will be pushed into next year. But in terms of Draghi Draghi, he's got one big strong card, and that is that he has a lot of credibility already won from in terms of the markets are concerned. The markets like him a lot, so they will be giving him a lot of confidence. At the same time, I think expectations about what he can deliver are also very high. So if he fails to do that, I think there's a lot of room for disappointment as well.
Yeah, no pressure on that front. Jane, it's always good to catch up. Thanks a lot. We look forward to having you again. Jane Foley, Head of FX Strategy over Rabobank. This is Bloomberg.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
It is time for the Bloomberg Business Flash, a look at some of the biggest business stories happening right now. I'm Karina Mitchell. U.S. retail sales rose in January by the most in 7 months. The 5.3% increase beat all estimates, and it suggested that fresh stimulus checks helped a rebound in household demand. The numbers may influence the debate over President Biden's $1.9 trillion stimulus package. In other news, it was another blockbuster quarter for Shopify. Canada's most valuable company beat forecasts on sales and earnings, and it expects revenue to grow rapidly this year. A measure of product sales flowing through Shopify's platform was up 99% from a year earlier. And say goodbye to the Trump era in Atlantic City. Take a look. The Trump Plaza Hotel and Casino was imploded earlier today. It was once the premier gambling location in the New Jersey resort, but after a series of bankruptcy filings, Trump cut ties with the casino in 2009, and it closed for good in 2014. He had 2 other casinos in Atlantic City, but now both are owned by other people. And that is the latest business flash. Alex.
All right, thanks so much, Karina. All right, let's focus on Ford for a second, because the company is joining the EV race over in Europe. The automaker is overhauling its business there, vowing to go almost completely electric by the end of the decade. Ford Europe President Stuart Rowley spoke to Bloomberg on the company's plans.
From 2026, all of our passenger vehicles will be zero emission capable, and by 2030, we will sell only battery electric passenger vehicles in Europe, investing $1 billion here in our Cologne assembly plant to transform it to our own electrification center. And this is where we'll build our first volume battery electric passenger vehicle in Europe from 2023.
A positive outlook, but for now, the outlook pretty grim for the auto market here in Europe. A rough start to the year for European car makers. Car sales in Europe slumping to a record low in January, basically thanks to the lockdowns faced by the continent's biggest markets. The sales down 26% last month. That's a year-on-year number. That is the steepest drop since May. And here's the interesting thing, Alex. Yes, we have seen showrooms closed. Yes, there is a chip shortage, which is also having a meaningful impact as well. But the outlook at the moment, judging by the analyst comments, isn't particularly rosy for the rest of the year. And I compare and contrast this with the conversation that we had yesterday with AutoNation in the United States, which sounded really quite positive. You got a lot of savings that are going to be spent. Demand for cars is still pretty high. And as a result of which, the outlook fairly rosy. Here in Europe, feels like a very different picture.
But I wonder just how long that picture lasts, because if we have stricter emission standards over in Europe and you're going to have to sell more EVs, Europe's already beating the rest of the world on a share of passenger car sales on an EV level, and now Ford's adding into that. What I also think is interesting is if we tie that to what we're seeing in Texas, Guy, because you brought this point up yesterday quite a bit, we're plugging in more stuff. If you're only selling EVs, all of those need to be plugged in, and then we're dealing with a more volatile climate. And do we have the charging stations? Can we build them fast enough? What happens if power goes out like in Texas? You can't go anywhere. You can't even get in your car to get heat. I think like this, all of this story sort of ties in medium term to this shift.
Yeah, and also there's other factors as well. Driving a car in cold weather, it doesn't go as far. Like I was talking to a buddy of mine over the weekend. I bumped into him in a car park going for a dog walk, and he just bought a new ID3. He was talking about the range difference for his Volkswagen on a hot day and a cold day, and it's absolutely massive. So yeah, I think there's a bunch of factors that still need to be kind of factored in here. But you do wonder whether or not actually the consumer is ready to make this decision. Are we kind of putting too many eggs in one basket? Is this consumer going to be happy with this? We had a huge push with diesel, and it didn't work out so well. I do wonder whether or not consumers, kind of once bitten, twice shy, are going to look at this EV shift and wonder whether government is really selling them the right option, or whether or not they should have other options in terms of the drivetrains that are out there.
If they keep giving them subsidies, and they keep paying them to do it, sure.
Exactly. But the same thing happened with diesel as well. We'll see how this one plans out. Maybe hydrogen needs to be part of the conversation too. Anyway, European markets are about to close. We'll show you the final numbers. Negative day here in Europe. This is Bloomberg. We're counting it down to the close here in Europe. We'll get through the auction. We'll show you the final numbers a little bit later. But this is the picture right now. We've been fading really in the last couple of hours. It's amazing. We saw some incredibly strong data out of the United States. On the back of that, bonds got bid and stocks got sold. Go figure. But it certainly had an impact in the back end of the European session. We're down by around 0.8%. But the rally thus far has been fairly rapid, and as a result of which, maybe kind of better to travel than arrive, and maybe that data is that moment. In terms of what we're seeing around the individual markets here in Europe, let's break it down. We've certainly seen some outperformance in the FTSE 100 over the last few days. We're kind of getting that a little bit again today. 67.13, we're only down by 0.5% on the continent. We're down with the DAX a full 1%. The FTSE MIB also underperforming. Again, the narrative around Italy has been really positive of late. BTPs have been catching a really big bid. That's just reversing a little bit. That then feeds into the banking sector. Italy trading down, as you can see, by 1.2%. Let's talk a little bit about that sector breakdown, that all-important rotation, that churn within the market. Yesterday, pretty much everything green. Today, pretty much everything red. Energy, the only outstanding story at the top, and a complete reversal as well. Look, utilities, bottom end of the market yesterday, sort of top end of the market today. You could almost take that block there, put it down there for yesterday, and bring the other way around. So basically a reversal in terms of the sector story, which gives you an idea about this more defensive nature the market's taking on here today. Let's talk a little bit about some of the individual names. I think they're worth focusing on, and they have been moving some of the sectors around as well. So let's start off with Rio Tinto. The miners actually continuing to deliver some really good numbers, and the Rio numbers today were no exception. But broadly, the market is lower, so Rio getting dragged down a little bit by that. It's down by 0.2%, but a really positive outlook. The dividend looking really positive. The outlook from British American Tobacco, the market was expecting sort of much better than this, and I think it's the guidance that has really shaped the narrative in terms of the price response today. The stock down by 3.8%, nearly 4% on BATS today. I think there's certain kind of idiosyncratic factors around what is happening here within this sector, and there's kind of a clear need to invest in the business. So that's one reason for the guidance. But nevertheless, I think the market caught a little bit by surprise. The stock that really caught everybody by surprise today was Kering, the owner of Gucci. The Gucci numbers were really horrible. We had some LVMH numbers just a few days back, and they were outstanding. Gucci, Kering really not delivering. So Kering down today, Alex, by 7.2%.
Yeah, brutal numbers there. Okay, so let's dig into that a little bit more with Sweta Ramachandran, GAM Investment Manager, GAM Investment Manager, I should say. Sweta, what happened to Gucci? Why was it so bad?
The focus on Gucci today, understandably, was on the top line print, where the organic growth was minus 10% for the fourth quarter, which compares to LV's fashion and leather goods segment, plus 18% in the same period. So LVMH, having led the pack in terms of reporting, really set the bar high. And unfortunately, Gucci couldn't clear it. Some of this was a result of self-inflicted wounds, such as a strategic decision to underemphasize wholesale, which is long-term a good move, but it did hurt the company quite a lot in the short term.
In terms of Gucci, it's, 100 years, the anniversary coming up this year. Can they make something of that? Is that going to provide a more positive tailwind for 2021? And how big could it be?
So that was certainly all the messaging around what is being planned for 2021 is related to this centennial celebration. They're planning a lot of events, and it's also a question of how to re-engage the consumer once stores reopen into a more immersive customer experience. And I think last year was really marked for the luxury industry by the story of local consumers with people unable to travel. And Gucci's historic under-engagement with the local European consumer was another reason for the very wide gap between its performance and LV. And I think that's another thing that they have in mind for this year as well, is to really commit to and engage with that local European consumer cohort.
Such an interesting point, because here in the U.S., just anecdotally, Midtown's like a wasteland, but you go out to Park Slope, Brooklyn, where I live, and the small stores are jamming. Like they're open, people are going in. It's a totally different circumstance. You mentioned Gucci going out of the wholesale market, and that's going to be a long-term positive. When do we see the fruits of that?
We're already seeing the fruits of it, which is that this company prior to the pandemic had about 22% of its sales for the Gucci brand from wholesale. And by the end of this year, they expect that that will be less than half of what they entered the pandemic with. And that is really another reason for LV's success as well, which is its 100% retail orientation, which really helps it tighten its control on the brand image and merchandising. And as the further Gucci goes along that trajectory, the better it will be for the brand longer term.
Sweeta, let's just talk a bit about fashion. I leave fashion to others. Let me assure you
Let's not talk about
that.
fashion, Guy. Come on now.
Yeah, not my strong suit. But nevertheless, I remember Tom Ford turning Gucci around and then the business being bought out. Michele did the same thing a few years back. Have they just lost their way from a design point of view?
So fashion tastes tend to be somewhat cyclical, and Alessandro Michele, when he burst onto the scene in 2015, really reinvigorated the brand with a lot of bright, exuberant fashion and colors. And it may be one of the elements that during the pandemic, people didn't have a lot of events to go to, and that type of fashion perhaps resonated less. I actually think it's a bit more basic than that. It's probably a little less focus on newness as the company itself was trying to cut costs and control inventories. Perhaps they dropped the ball a little bit in terms of innovation and newness, which again, all of us being trapped at home were desperately in search of. And so I think that should be fairly less complicated to rectify than through a wholesale designer change again.
And just to point out, Guy has 3 pairs of shoes. That's why he's not allowed to comment on fashion. I mean 3, please. Okay, so who benefits from Gucci as they're trying to make all this happen?
I think in the near term, it's clear that the share of market growth that's accruing to the competitors is greater with the sort of vacuum that's been left by Gucci. I mean, Prada's recovery has been quite impressive. By the end of December, they said they were back to flat retail sales. Obviously, LV is in the firm ascendancy. And I think, you know, if I were to look at this as a marathon, this would be the point of the race where there's one leader that's clearly broken away from the rest of the pack, and that would be LV with its Louis Vuitton and Dior brands. I mean, that said, this is a very fragmented industry. Of the $281 billion of sales that it generates annually, about the top 100 companies generate only an average of $2.8 billion in sales. So to be anywhere among the top 5, which is where Gucci is not necessarily something to be sneered at.
I should point out that Alex has just moved apartments and she has a special cupboard closet for her shoes.
I am getting a built-in closet for shoes. It's a shoe drawer where you slide it out and you can line up all your shoes and see them. It's true. I know. I'm a terrible person.
Lucky you.
See? You get it, Sweeta.
Yeah. These are important things, apparently. We've got, what is it, Hermes this week, or Moncler this week. What are you expecting there?
So again, a bit of a mixed bag. I think it's clear now that LV's performance was really one of a kind. That said, I think the exit rate, i.e. the performance in Q4, is obviously what everyone's looking at. Hermes tends to be much more of a steady delivery story. They never, you know, you're never going to see them report 45% revenue growth, which is what Gucci was doing in 2016, 2017. I expect this will be a fairly predictable set of numbers from the company. Moncler will be interesting because, of course, they are quite heavily reliant on long-haul travel into Europe, which didn't materialize this winter. At the same time, in China, there's been a huge rise in appetite for skiing, and the country ski resorts are enjoying a bit of a golden age. So it'll be interesting to see whether they've been able to get some of those foregone sales from Europe in China.
It'd be interesting to see what data come out of the lunar holiday. Really looking forward to seeing exactly what's happened during this period. A lack of travel again, a little bit in China. Maybe that'll impact the numbers. Sweeta, thank you very much indeed. Sweeta Ramachandran of GAM Investment Management. Thank you very much indeed. Let's talk a little bit about the final numbers here in Europe. I want to show you what is happening. We're starting to get the final figures coming out. A little tick lower for the FTSE 100. We're dipping just a little bit, and what you're getting there is just a kind of settlement out, a little bit of a negative sentiment towards the end of the day. This is Bloomberg.
Bloomberg.
So the EU ramping up its vaccination push, tripling its order of the Moderna vaccine and finalizing a further agreement with Pfizer and BioNTech for 200 million more doses. The Belgian Astra plant's also ramping up as well. Sam Fazeli of Bloomberg Intelligence joining us now on the line. Sam, there has been much criticism of the way that the UK has operated from the continent. We're now starting to see the continent getting its act together in terms of deliveries. What is the prospect of being able to catch up?
Well, Guy, as you know, ordering doses and receiving them in an airplane or whatever is not really that doesn't cover the population. You need to get it into people's arms, and they have to organize their infrastructure. Remember, the U.S. had all its doses. There was no issues with well, maybe a little bit of a supply delay, but certainly nothing problematic majorly there, and the issue was there to get the system running, get the infrastructure in. That's what the European Union needs to do, and then we'll see how that pans out. Let's see them deliver.
We have also been hearing in the U.S. sort of conversation about spreading out those doses to more than 12 weeks, which is what the U.K. has been doing already. What's the validity there?
Yeah, so we know now with the data that's been published, which is all we've ever asked for, show us data, that AstraZeneca's vaccine actually seems to do better when you spread it out to 12 weeks or more. So that's fine. But of course, it does mean that while you're waiting for your second dose, and even after, but definitely while you're waiting, you have to be very careful. Now, with the Pfizer vaccine, we don't know how that works, and data has to come out. The UK can produce data on that, because that's what they're doing. We have just had some data out of a Cambridge laboratory from Ravindra Gupta's lab that showed that those over 80, about 50% of them seem to not get enough antibodies just after one dose, which means they're still at risk of catching COVID. But what was good was that you did have an activation of another arm of the immune system equally well after one or two doses, which could prevent severe disease or hospitalizations. So one step there, but not quite.
Right, which I feel like sort of encapsulates the whole vaccination process. Sam, thanks a lot. Sam Fazeli of Bloomberg Intelligence. All right, let's now turn to COVID-19 treatments, because as Sam said, even if you are vaccinated by one shot, you can still catch it, but the variant is also the next question mark. We want to welcome Trust's Nick Kamak. Nick, you guys do a lot of research when it comes to therapeutics, one of the largest scientific research funders in the world. What kind of therapeutics are we still going to need to have if, as we're starting to realize, COVID is going to be with us for a while?
Yeah, so well, thanks for the opportunity to talk about treatments, which have to be part of the global response to this disease, alongside vaccines and, of course, diagnostic tests. We saw great data this last week from the recovery trial on tocilizumab, which gives a benefit of one more saved life out of 25 people who are, in hospital in a severe state of the disease, who are also having oxygen and the dexamethasone corticosteroid. So we need more treatments at that end of the spectrum to stop people progressing through this severe period of disease. And then ultimately, we want to find treatments that will actually stop people getting into hospital in the first place. Even now, we're rolling out the vaccine, just heard there from Sam. It'll take a couple of years, 18 months to 2 years, to vaccinate everybody around the world. And in that time, you imagine we've been going for just over a year. That means a lot more deaths from COVID if we don't find treatments. So finding drugs that will stop people going into hospital, or if they go into hospital, getting them out quickly, is key. Yeah.
Can we just talk about one of the things that obviously is causing concern at the moment, and that is new variants?
Yeah.
And I'm wondering whether therapeutics are better at keeping up with the new variants and providing a safety net against new variants than maybe the vaccine programs are.
Yeah, so the front-running therapeutics, which are pretty exciting actually, are monoclonal antibodies. They're human, so we have the benefit of knowing they're going to be very safe. The disadvantage is that they are susceptible to variant changes. And I think if we already know, not proven in the clinic yet, but some of the front-running monoclonal antibodies are affected by particularly the South Africa and Brazil variant. But there'll be others behind that that will target parts of that spike protein on the coat of the virus, which are conserved across all variants, and then therefore will be effective. I think behind that, there will be other drugs that target other parts of the virus, for example, involved in making new virus, that won't be susceptible to those variants. So I think we've had a little bit of a setback with the variants appearing, but we should get back on track, particularly with the monoclonal antibodies, quite quickly.
Something that's also emerged are the long-term effects of COVID, that many people get it and they just can't recover in different ways. What kind of therapeutics are being worked on to address those issues?
So, there's still thinking that maybe the virus is sort of hanging around somehow. And so direct antivirals may have a benefit, and we'll see that tested once we have them available. But equally, I think the continued evaluation of the range of other, particularly anti-inflammatory drugs, because that whole second phase of the disease is very much an over-exaggerated inflammatory reaction. So continued evaluation of those drugs may reveal additional options that have benefit in long COVID.
Nick, one of the things we're witnessing this winter is an incredibly weak flu season. That probably won't be the case next year if we don't have the lockdowns that we're currently experiencing. How much of what is being developed on the therapeutic side will also be useful for influenza? Influenza remains a significant killer most winters.
So, the first thing we did when COVID-19 came along, because we'd never seen the virus before, was test all the drugs for other infections, including flu drugs. And then they don't work. And so there is no overlap between the two. And we're going to need, the flu approaches alongside COVID approaches next winter too.
Something else that we're sort of trying to figure out is what the role of hospitalizations will become. Like, will we get to a point where we can get COVID but not be hospitalized and we're just okay? Like, is there ever going to be a point where that's our base level?
So, of course, if you're vaccinated, you're going to be in great shape.
But even without the vaccination, Nick,
okay,
with the therapeutics.
Without the vaccination, I think already companies like Lilly, Regeneron have shown if you give the antibodies before infection or just on infection, it will have a massive effect and prevent you going into hospital. So I hope if we get all this right, so vaccines, drugs, and the diagnostic tests, COVID will become, a manageable disease that won't involve large numbers of folk ending up in hospital and some dying.
Nick, final quick question. Do you think this area is getting enough funding?
So, we worked out that about 3 billion, sounds like a big number, would deliver what we need for treatments, and particularly even just down to the oxygen needed for the folk in hospitals all around the world. 3 billion, the world's economy coming back after that, and would be sort of dealt with in about a day of the world's economy. So 3 billion's peanuts to get us all back on track. So.
Yeah, I think most governments will probably agree with that, considering how much is being spent elsewhere. I guess it's just kind of the sequencing and the ordering, making sure it all happens correctly. Nick, thank you very much indeed for your time today. We really appreciate it. Nick Kamak of the Wellcome Trust. Thank you very much. This is Bloomberg.
I feel we have a very good chance to not only have positive growth, but perhaps a somewhat more encouraging positive growth.
The rebound in the second and third quarter will be quite strong because the expectation is that the vaccine will help clear the way to less restrictive lockdown.
We are going to have a recovery, but it's going to be an uneven recovery.
Of course, it will have direct impact on our growth forecast, and it will be very difficult to reach 6% of growth.
You're going to get a roaring 20s type of recovery and a boom period.
We are certainly seeing ourselves towards the second quarter being in almost opening the economy as much as one can.
We should not be too quick to cut back on the expansionary fiscal policy.
We'll get there. The question is not a question of if, it's a question of more when.
Their CPG history, their experience, and really how we might be able to combine together to really create this fantastic public company. And so we kind of got into the SPAC thing a little bit before it became such a hot method of going public.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
Live from New York, I'm Alex Steele. Guy Johnson's over in London. This is the European close on Bloomberg Market. So we want to focus back on Texas here, really not catching a break. After hours without power, another winter storm is now on the way that could bring icy rain. Joining us now with the latest, David Weston, host of Balance of Power. David, you have a congressman from Texas on, and I'm curious as to the line of questioning, sort of what you think. There's so many ways to parse this, and it feels like it's become partisan already, and so I'm curious how you cut through that.
Yeah, well, Alex, actually, this is a congressman asking questions himself. He's one of 10 Democratic congressmen now from Texas. Al Green is who we have on. He's from Southwest Houston, basically, and they've asked questions of ERCOT, as you know, that Texas organization supposedly for energy reliability, asked some very probing questions about how you're deciding when to shut down, what to shut down, how to bring things back. What's your plan if this doesn't work, by the way? And they've demanded answers by today. They're pretty impatient.
Is this a Texas issue, David, or is this a DC issue?
Well, it may become a DC issue, and Alex really knows this better than I do, but Texas, maybe unique among the states, has really said, don't bother us too much as a federal matter. We're going to handle this within our borders. We're going to have a different way of approaching the power grid. We're going to be less regulated, more decentralized, not connected very much. So the question really is, I think it's a good one for Alex, actually, will this trigger more federal regulation to protect people like the 3 million people still without power in Texas?
I don't know how you regulate it if they're not hooked up to the grid. I mean, that's the whole point. They don't want to connect to the rest of the grid because they don't want that kind of regulation. I think the problem becomes, David, is that there's no price incentive to fix stuff. Like, you're not going to insulate a wind turbine, for example, or get better pipes to deal with cold because financially there's not the incentive to do that. To do it, you're going to need regulation, and I'm not sure if this episode is going to be enough to financially incentivize.
Well, we'll see. Congress may have something to say about that, but as you say, Alex, this is in some sense fundamentally a business model problem because Texas seems to have a different business model for its energy, and they have regulated with regard to price, but mainly to maximize profits for the companies within Texas. And often, if you're going to maximize profits, you don't have excess capacity. You don't worry about little problems like frigid cold.
Yeah, you've got to have a plan B, and I certainly think this episode is proving that a plan B would be useful. That is how most grids tend to operate. But David, the federal government is about to spend a ton of money on infrastructure. Like, it must have a voice at the table here in terms of the way that that money is ultimately going to be spent and then used by states like Texas.
Absolutely, and it's interesting, the infrastructure discussion plays into this quite quickly because one of the issues is about wind power, and is there a weakness to wind power because it's hard to store it? We haven't invested in the infrastructure yet for wind power, but again, as Alex knows well, there really is a dispute. It looks like people came out with talking points yesterday pretty quickly saying it's all the fault of wind. Now it appears, I've seen that chart, Alex has seen that chart, that ERCOT, the organization itself in Texas, has a chart showing actually wind has been overproducing what was projected, so I'm not sure we can blame it on wind the way some people would like to.
No, you definitely can't. There are obvious problems with wind. One of them obviously is that you need to insulate the turbines if it's cold, which you didn't do in Texas, but also you need storage. And this is a problem that's been talked about quite a bit with natural gas and solar and wind. You need a certain type of storage so you have that back load for energy. They don't have that right now, so it's not. That's why you need coal and nuclear. That's where the problem is. But really, it was natural gas. That was the really big issue across the board. You had plants just go down. We don't know why yet.
Yeah, they rely so much on the plants, and I've read some reports that it really was the frigid cold really interfered with the pipes, and a lot of the equipment that manufactures the gauges and things like that just got frozen. But your point is so powerful, Alex, that there are ways to winterize. They do it in other parts of the United States of America, but Texas apparently decided not to spend the money, perhaps because it doesn't get cold in Texas, but given what's going on with climate, I think they better anticipate some extreme climate coming forward.
David, looking forward to the show, looking forward to the conversation. Certainly some answers are required here. David's going to pick up with Balance of Power on Bloomberg Television. Alex and I are off to Bloomberg Radio for the cable show. Join us on DAB Digital. This is Bloomberg.
What's the biggest mistake you made when you were a fresh MBA grad and looking for a job?
Make sure you try to do something that you're interested in and that you think you'll be good at. I just was on a path to law school, and I actually never asked myself why I wanted to go to law school. And I randomly went to an investment banking analyst recruiting event, and I figured out I had an aptitude for it. I was interested in the work. If you're not interested in it, and it's not something you're good at, the money will not justify it. I also think that there's nothing wrong with experimenting. Doing something that you always thought you might want to do, or trying it for a couple of years, you can then go back down a traditional path if that's what you want to do. Try to remember what you want out of a job, where you want to live, what you want to get from it, from personal experiences, from development, from training, from fulfillment, from engagement in the community, and make sure you think about those things up front as you're recruiting and not try to evaluate it after you got there.
Start your mornings with Bloomberg Surveillance. Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Extraordinary market day.
This rally just keeps on going.
But there is a tipping point.
The business team you love to watch. Weekday mornings on Bloomberg Television.
Trading revenues coming in better than expected. Everything cash, $1.4 trillion of cash. One of the most notable aspects of this report that was stellar.
From Bloomberg World Headquarters in New York to our TV and radio audiences worldwide, welcome to Balance of Power, where the world of politics meets the world of business. I'm David Weston. We're going to start with a check on the markets and turn right now to Abigail Doolittle. So, Abigail, looks at some softness in the equity markets, but the NASDAQ is what really jumps out at me.
That's certainly the case, David. The NASDAQ and big tech, those mega caps, really underperforming on the day. And for the first time in a really long time, at least to me, it doesn't just feel like the one side of the reflation versus the stay-at-home safety money trade, it actually feels like big tech is selling off. Now, a piece of it is certainly Apple. We did get news via the 13Fs recently that Berkshire Hathaway, Warren Buffett's firm, did trim their Apple position. It's still their top holding, but nonetheless, maybe a cautionary move. The stock is certainly taking it or is down for some reason. That seems to be the one fundamental thing that really stands out. Back below its 50-day moving average, the worst day since January 29th. So since that stock has a bigger weighting to the NASDAQ and the New York FANG index and some of those other tech indexes, that's really where we have the weakness. It's going to be interesting to watch this play out. The other factor, though, David, is the one that we've been talking about, and that is the fact that we do have rates higher. Today, keeping with the risk-off tones, rates are actually lower, so bonds are rallying a little bit. But over the last 5 days, you have this huge backup for rates. Yesterday, the 10-year yield back above, if you can believe it, 1.3%, which historically is very low, but over the last year seems very high. So we may be getting a signal that that level is a cause for repricing of risk, the fear of inflation versus that healthy reflation.
Yeah, if it happens, then you have to watch out with the equities. Thank you so much to Abigail Doolittle for that report on the markets. We're going to turn now to that continuing power crisis in Texas, as some 3 million people are still without power, and many may be for several more days. 10 Democratic congressmen have written a letter to ERCOT, that's the Texas Energy Reliability Council, demanding some answers. And we welcome now one of those congressmen. He is Congressman Al Green, whose district includes a good part of Houston. So, Congressman, thank you so much for being back with us. You wrote this letter to ERCOT. You demanded answers by today. Do you think you're going to get some answers today?
Well, thank you for having me on. I certainly hope that we'll get the answers. Not sure what ERCOT will do right away. I was on a phone call just recently where we had some explanations given as to why we're suffering some of these dire circumstances in Texas. As you well know, roads have been closed. We have blackouts, rolling blackouts that were supposed to last hours that are now lasting days. We have persons in nursing homes, senior facilities that are in need of electricity. I just got a call recently from a prison wherein they're asking for help. They need water. So there are emergencies, and we do need answers. And I'm proud to be a part of the letter. Mr. Castro is the actual author of the letter, and I'm proud to co-sponsor the letter with him.
Now, we've seen some data here at Bloomberg that suggests that things may not be getting all that much better in terms of the amount of power being produced. If anything, it might have gone back a little bit over the last 24 hours. One of the questions you ask of ERCOT in your letter, Mr. Castro does, that you signed on to, is what's Plan B? Do you have any sense whether there is a Plan B?
I do not get a sense that there is a Plan B. I get a sense that the management of the flow of electricity across the grid has become a challenge. And because there is not nearly enough, there will have to be these blackouts. And ordinarily, we would, in a state the size of Texas, be able to move our electrical power from one part of the state that's not being impacted adversely to another part that is. But we have the entire state that is adversely impacted. And when you have a state and a region with the same problem, it's difficult to do things other than what's being done. But the question is, how prepared were we for this eventuality? There seems to be a need that has not been properly diagnosed. And we need to get to the bottom of what should have been done and why it was not done, and who was responsible for getting it done.
Give us a sense in your district. You mentioned some of the really inconvenience and even more than that, some danger being experienced by people down there. Are there things that you can do or the government can do to try to alleviate some of the problems, whether it's heat or power or water?
Well, there are things that we can do, but they still have there's still an adverse impact being felt by people. For example, we can have these rolling blackouts, but you still have someone who will be without power. We have now water having to be boiled in Houston and in Fort Bend County, which is a part of my district as well. We have these stories from people who will leave home to go to one hotel, and they discover that the power is out at the hotel. So you go to another hotel, the power is out at that hotel. Go to a relative's home, the power is out at the relative's home. Literally, that has happened to a person that I'm familiar with. So the challenges are great, and the outlook is not good as long as the weather stays within this freezing range. Our hope is that we'll get better weather, which means that we'll get some different results.
Do you have any sense of the role, if any, that the renewable energy area played in this? Because we've heard from some people who say part of the problem is you went too fast to wind and solar.
I've heard this as well, and I respect the person, one of the persons who said this. I consider the person an honorable person. And the allegation is that with the wind, you have the cold such that it impacts the turning of the blades for the wind towers, literally frozen up. And you can't generate power unless those blades can turn. Well, I believe that you have to solve problems along the way. And this is a problem that has to be addressed. But it does not mean that we should step back now from what is our future. Our future is not in fossil fuels. It is a finite fuel source. We have to move to other forms of energy. It is of necessity that we will do it. And we need not allow a minor setback to be anything other than an opportunity for us to come back better. Perhaps we can use the term build back better.
There you go. And some people have observed that Canada and parts of the northern United States have wind turbines, and they've winterized them. That can be done if you invest the money, which maybe is something that will have to be considered in Texas. Let me make a turn now to something else. You were a member of the House Financial Services Committee. There's a big hearing tomorrow on what happened with GameStop and Robinhood. Give us your sense about what you're looking for to come out of that hearing. What are the questions you're asking?
Well, there's some significant questions. I will submit more than 20 questions for the record, and these questions will be made public at an appropriate time. But one of the key questions, a gravamen, if you will, that has to be dealt with is, did Citadel have undue influence on Robinhood's restrictions? Citadel has a relationship with Robinhood. I want to know more about that relationship. I want to know to what extent that relationship accorded Citadel some undue influence, if it did. This is important. But I'm also very much interested in how the order flows are processed. Does Citadel have reason to process principal order flows from Citadel ahead of Robinhood's order flows? And I must say this is an area that intrigues me because Citadel has the ability to engage in high-frequency trading. And I want to know if this puts those retail investors from Robinhood at some sort of unfair, unethical disadvantage. This may open up a can of worms that will necessitate more than one look. Yeah. There's a lot to be examined, and I think that tomorrow will open the door, and we'll see where we'll go after the door is open.
And as I'm sure you know, it's a very complicated area that you get into. You're going to hear from Ken Griffin, the head of Citadel, but there are two Citadels, right? There's a Citadel that's the hedge fund. There's a Citadel that's Citadel Securities that cleared a lot of the trades, and the relationship between those two is not clear, at least in my mind. A lot to find out. Let me ask you, though, when we look at the members of the House Financial Services Committee, very few actually are involved in the equity markets, and that's good in a sense because that means there's no insider trading or something. On the other hand, does it put you at a disadvantage because you don't deal in the equity markets as regularly, and it is a very complicated area?
Well, we don't deal in it regularly. Some of us have lost money in it. I don't know whether that means that we're inappropriately dealing in it. Some of us have made money in it. So I can only say this, that we have people that are gifted and talented, and we are making sure that we understand the language that we have to deal with. You mentioned Citadel Securities and the venture capital side, but they do have a common nexus, and that is a common person. So we will probably want to know about some of that type of engagement, but we also are making sure that we understand market flow, that we understand the bid-ask spread. These things are not incomprehensible. It just takes a person some time to acquaint himself with the language. You know, I'm a lawyer. We have our own language. If I ask you well, let's not do that one. I was thinking of something that is X-rated, so I won't answer. But my point is that each of these professions has its own language, and we just have to delve into it. But that's all we have to do.
Well, res ipsa loquitur there. I'll throw one out for you. It's been a while since I've been in law school, but I remember that one. Okay.
Yeah, what a great doctrine.
That's right. Okay. Thank you.
Things sometimes speak for themselves.
That's right. Exactly right. Thank you so much to Congressman Al Green. He's Democrat of Texas. Coming up, we're going to stay with the Texas power crisis and what it means for President Biden's green agenda with Bill Richardson, former U.S. Energy Secretary. This is Balance of Power on Bloomberg Television and Radio.
Isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
Women leaders were actually better at controlling the deaths from COVID-19. Do you think out of this pandemic, we'll see more countries be willing to elect female leaders?
When we look at women leaders, we tend to project on them baggage that they shouldn't bear.
Women are given an opportunity when no one else wants to do the job.
Women had a very clear objective. They wanted to save lives.
The women leaders, if you look at their careers, have also built up a level of trust.
In fact, women have to be better at communication in order to be elected as leaders, whereas this doesn't hold true for men.
We need to get those sexist stereotypes out of our head and give women a fair run for leadership.
Trying to change the stereotypes about women is not only the business of women, but men have to be part of it.
Global markets never sleep, so stay connected with Francine Lacqua in London, Matt Miller in Berlin, and Kaylee Lyons in New York. Perspective on the day ahead. Bloomberg Surveillance, early edition. Weekday mornings on Bloomberg Television.
This is Balance of Power on Bloomberg Television and Radio. I'm David Weston. For Bloomberg First Word News, we go now to Mark Crumpton.
David, thank you. The European Commission secured 300 million additional COVID-19 vaccines. The Commission has been under scrutiny for a vaccine rollout deemed underwhelming. Here's the Commission's president.
The increased spread of the new COVID-19 variants, first identified in the United Kingdom, South Africa and Brazil, are a potential paradigm shift in the global fight against COVID-19. We need to further upscale mass production of new vaccines, but also of existing vaccines.
In addition to the Moderna contract, the EU's executive arm finalized an agreement with Pfizer and BioNTech for 200 million more doses. President Biden says he invoked a federal law to speed up production of the coronavirus vaccine. The president told a CNN town hall meeting last night that Moderna and Pfizer agreed to sell more doses of the vaccine to the United States faster than planned. Last week, the government announced there would be enough doses by the end of July to inoculate all American adults. Utility operators struggling with that deep freeze in Texas have a warning. Those rolling blackouts could keep parts of the state in darkness for days. The power cuts were implemented for a second day in a row to prevent the collapse of electric networks. Outages spread last night to more states, including Arkansas, Louisiana, and Mississippi. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in over 120 countries. I'm Mark Crumpton. This is Bloomberg.
Thanks so much, Mark. I want to stay on that story of the continuing power crisis in Texas. It is raising some fundamental questions about U.S. energy policy and the Biden administration's plans to move us rapidly toward green alternatives. For the broader picture, we welcome now Bill Richardson, former Secretary of Energy under President Clinton. Mr. Richardson has also served as governor of New Mexico and U.S. ambassador to the United Nations. Mr. Ambassador, thank you so much for being with us. I left off the fact you were a congressman as well, but there's too long a resume there. So thanks for being with us. So give us your sense right now of what is going on in Texas and how it might affect overall U.S. energy policy.
Well, we have to understand that Texas has a very decentralized grid, unregulated energy, but it's our major producer. And, you know, we're neighbors, Texas, New Mexico. We do a lot of natural gas, shale together. So what I think needs to happen is, one, yes, ERCOT, I think those congressmen are right. They need to come up with some answers. What is Plan B? Better information to the public. I mean, this affected 4 million human beings in Texas. But I think as for overall energy policy, I think President Biden's in the right direction. I think the answer is to move towards renewable energy. Although at the same time, I think you can't eliminate natural gas. You can't eliminate coal. You can't eliminate petroleum. I mean, this is the lifeblood of many states. But what I think needs to happen, David, is one, more renewable energy investments. For instance, what happened in Texas? I think the president is right to say we have to improve our electric grid, not just bridges and highways, but our electricity grid with coal protection. I think if some of these companies that invested in coal protection, in water for some of the coal and natural gas facilities, protect from this climate change, which is climate change, the freezing. So I think the president's in the right direction. You know, I don't agree with everything, the Green New Deal, because, but I do agree that the shift has to be towards solar, wind, and I believe that to blame solar and wind, and as some politicians are doing now, is not the answer. I think there has to be a concentrated national energy strategy that moves towards renewable energy.
And Mr. Ambassador, I want to return to that just a moment, but I'm sorry, I have to interrupt us on a sad note here. Rush Limbaugh died today at the age of, it says 70, that's wrong, after a battle. We knew he was battling with lung cancer at the age of 70. That was announced by Fox News, citing a report from the family. We know he was a giant in talk radio. You could agree with him, disagree with him, but he sure made a big difference in this country over the course of his career. So I'm sorry to interrupt us with that sad note, Mr. Ambassador. Let's go back, though, if we can, to what you were talking about. A lot of people jumped pretty quickly on the renewables as part of the cause of the problem in Texas. That is to say, specifically those wind turbines that apparently froze, couldn't rotate. I've heard very conflicting things, because I've also seen some projections from ERCOT saying, actually, we're getting more energy in Texas out of wind turbines than was projected at this point. Do you have a sense of the truth of that?
Well, 23% of energy in Texas comes from renewable, from wind. And wind is operated well. The cost is going down. The technology gets better. The same with solar. But I think ideologically, some politicians say, oh, you know, it's a Green New Deal. It's wind that's the power. No, what was affected in Texas was coal plants, natural gas plants. I mean, just also in New Mexico, the Permian Basin with Texas was affected. Some of the drilling is stopped because we don't have in the coal plants in Texas enough water. And you need investments in coal protection in the grid. And so I think this is a national problem. It could happen in another state. It's not just going to happen in Texas, the supreme power. So I think the future is renewable. I think we stick with that, but also improve our grid. But don't say that you're going to eliminate natural gas. I think you can do shale and fracking with strong and good regulation, environmental protection. You're not going to eliminate that. That's not going to happen.
We talked with your successor as Energy Secretary yesterday, Dan Brouillette, who worked for President Trump. And he said part of what we need is we need investment in infrastructure for storage, for things like solar and wind. That, in fact, those are very efficient, as you know, very effective ways of generating power, but we don't have the right way to store it yet. Is he right? And can we get that?
Yeah, he is right. That there's no question we need better storage capacity, but this is going to be a national strategy. But at the same time, you don't downgrade wind and solar because they're getting better technology, they're cheaper, they're great job producing, green jobs for Americans. You know, in Texas, there are a lot of green jobs. It's not just natural gas and oil jobs. So, but yeah, storage, but also infrastructure improvements, cold protection facilities, ways that we integrate the grid. You know, Texas has chosen to be an independent grid, fine. But I think there should be some kind of integration and a little more national regulation to ensure that these ERCOTs, you can't just blame them, David. They're being blamed for everything, but they got to get information out better. They got to answer what happened. I mean, this is a national strategy that needs to be developed. It's not just Texas, even though Texas is our #1 energy producer.
We've learned a lot about the Texas different approach to energy. Is there anything the federal government could do to make them integrate with the rest of the country when it comes to the power grid?
Well, you can't make them. A lot of these regulations are state regulations, and we know Texas is very independent, and they're major producers to energy in our country. So Texans need to make these decisions. But I think when it comes to energy policy, I think if there's a shift, a recognition that we have to move towards renewable, we have to develop the grid better, the infrastructure better. We maybe have to integrate the FERC, some of these energy entities that regulate energy closer to Texas, maybe not fully take it over. I know Texans don't want to have their energy decided nationally, but look, 4 million human beings lost their energy, and a lot of poor people died. I mean, it's not good what happened. So there's got to be a national strategy, and Texas should be part of that national strategy instead of saying, well, we're going to do it ourselves and we're going to fix our own problem. That's what I would.
Mr. Ambassador, always great to have you. Thank you for being here. That's Bill Richardson, former Energy Secretary and New Mexico Governor. And we want to repeat the report that Rush Limbaugh has passed away at the age of 70 after battling lung cancer. It was announced by Fox News. As we know, he was a legendary afternoon talk radio show host, really almost created a genre. Rush Limbaugh has passed away at the age of 70.
Let's just start with the numbers.
And it would be essentially free cash flow positive in 2021. That was sooner than people had been expecting.
We have pretty good numbers here in the biggest divisions of Morgan Stanley. They are firing on all cylinders.
We've had this huge rivalry historically between Morgan Stanley and Goldman Sachs.
There are 24 reasons for Mr. Diamond to celebrate today.
As much as people may want to focus on trading, for Bank of America, it's all about credit.
It seems the markets are very happy with Trump. They're very happy with Biden.
Trading revenues coming in better than expected. Everything cash, $1.4 trillion of cash. One of the most notable aspects of this report that was stellar.
I think what we've seen during this period of time is that communicating via video is not a fad. We are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
This is Balance of Power on Bloomberg Television and Radio. I'm David Weston. It's time now for our stock of the hour. We're looking at the cannabis seller Sundial. Shares are getting crushed today. Emma Chandra has the explanation. It has to do with a shelf registration, as I understand it, Emma.
Yeah, that's absolutely right, David. So we're seeing Sundial shares falling some 16% today, and this seems to be investors concerned about the risk of dilution that could come from that shelf registration. Shelf registration is essentially a filing with the SEC from a company, allowing them to make what would basically be a secondary offering at a future date, no specified date. And what's interesting with Sundial is that they made this filing for $1 billion. That is a lot. That's a big number, given the market cap of the company is some $3.2 billion. So what they've done is that now allows them over the next 3 years, should they want to, they can sell stock, warrants, preferred stock, or a combination of that to that value should they want to in the next 3 years. Of course, some investors don't like that dilution risk, and that's why they're getting out today. But it's interesting that it's coming at this time, of course, because we have the House hearing tomorrow on Capitol Hill into GameStop, and Sundial was one of those pot stocks that saw its share price get pushed up by that retail investor craze, and this may be a way of them banking in the future that they might be able to make a share sale.
Hard to resist cashing in on that high stock price. Thanks so much to Emma Chandra. This is Balance of Power on Bloomberg Television and on radio.
It's extremely exciting for the university, for being a historically black college and university. It's just exciting for our engineers to actually be allowed to work for a large firm such as Boeing with such technologies that we can see the outcome.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
I'm David Weston. Bloomberg Television is reinventing one of the most iconic brands in financial television for a new audience. Join me to see the news program for the clever investor. This is Bloomberg Wall Street Week.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
I was very worried for a variety of reasons about the prospects for New York City. I am much more concerned today after the catalyst to exit that COVID represented.
That, of course, was former Treasury Secretary Larry Summers expressing his doubts about the recovery of New York City from the pandemic and resultant economic downturn. We welcome now someone who wants to take on that very challenge. Before becoming a candidate for mayor for New York, Sean Donovan served as Secretary of Housing and Urban Development in the Obama administration. And before that, ran housing in the administration of New York Mayor Mike Bloomberg, the founder and majority shareholder of our parent company. Mr. Donovan, thank you so much for being with us. Let me ask you why you do want this job. Why do you think you could turn it around? Because it doesn't look too pretty right now.
Well, David, you just had Larry Summers on. I think he would tell you, and President Obama, President Biden, Mike Bloomberg would tell you, there's no one in this race who has the deeper and broadest experience in crisis that I do. I was housing commissioner in this city in the wake of 9/11. I was housing secretary in the midst of the worst housing crisis of our lifetimes. When Sandy hit our shores, President Obama asked me to lead the entire federal recovery effort. And because no good deed goes unpunished, he asked me to lead the $4 trillion federal budget. 3 weeks into that, Ebola emerged, and I was side by side in the Situation Room with Dr. Fauci, all of our leaders across government, making sure a global health crisis didn't become a pandemic that cost tens of thousands of New Yorkers their lives. So New Yorkers want a public servant, not a politician, and they want someone who really understands what it means to lead through crisis, and that's who I am.
So let's skip over the messy little details about getting nominated and getting elected and things like that. Let's put you in the office. What's the first thing you do? What's your first 100 days? We know what the problems are. We've got tax-based problems. We've got crime problems. We've got a lot of small businesses going out of business. Where do you start?
Well, first of all, we need a mayor who won't demonize and divide New York, but bring everyone together. I would first commit to being the mayor for all New Yorkers. Second, we have to understand that there's no path to recovery without getting the virus and our health under control. I would not only make sure that we were ramping up vaccines and other testing and contact tracing if we're still in the midst of this pandemic. If not, I would make sure not only every single New Yorker, but the entire world knows that we're the safest place to do business and to live. That's why I've made a Safest Cities commitment that is the beginning of rebuilding 500,000 jobs in New York City. And it's why I would make sure that we're using every avenue, not just to make sure New York City is safe, but to make sure everyone knows it so that people will come back to work, come back to live here, and that we can rebuild our tourism, arts, and culture and drive our economy back to where it should be.
Well, I was going to ask about that specifically, tourism, because people may underestimate the extent that really drives the economy of New York. Right now, I mean, tourists basically can't come because they got nowhere to go. But there also is a perception that the city's in decline, and the crime rate really is an issue, isn't it, for tourism?
Well, look, I learned this from Mike Bloomberg. I learned it from the best mayors across the country and across the world that I've worked with. I'm unique in this race because I have worked with mayors across the globe to tackle these kinds of problems. And let's recognize that in this economy, talent decides where it wants to live and companies and capital follow. If you believe that as I do, quality of life is the single most important tool that a mayor has to be able to make sure that we're driving job growth and economic development. That's why I have the most comprehensive public safety plan of any of the candidates in the race. It's also why my experience in dramatically reducing homelessness and other challenges we see across this city would be put to work to make sure that we actually make our streets not just safe, but actually places that people want to be, bring our restaurants back to life. Part of this also, we have to recognize we need a mayor who can get the help we need from Washington to do all those things. No one in this race has the same relationships I do, not just with President Biden and Vice President Harris. Nearly every single advisor in the Biden White House is not only a former colleague, but a close friend of mine. These are folks I can work with very effectively, and members of Congress, to bring the help that we need to revitalize the city's economy.
You talked about attracting and holding on to talent. Another thing that talent doesn't like to do is pay taxes. What does that mean for tax rates as a practical matter? We see a lot of people from Wall Street really taking a hard look at places like Florida, in large part, because of the tax situation.
Well, look, David, New Yorkers want results, not rhetoric. And What they know is that President Obama trusted me to lead the $4 trillion budget of this country. People forget that when we came into office, we had the worst budget deficit since World War II, and we were able to bring it down faster than any time since World War II, while still making big investments in growing jobs out of the Great Recession, in investing in infrastructure, in clean technology, so many different things that we need to do in New York City. So I'm the only one in this race with the deep experience to know how to get our budget under control and to do it in a way that we don't make New York even less affordable than it's been with our taxes and other challenges. I'm the only one who's really put out a detailed plan. We need to do three big things. Get the help that we deserve from Washington, D.C. Remember, New York sends $23 billion more each year to Washington than we get back in return in services. That needs to change under a mayor who can actually get the help we need. Second, we need a mayor who's actually managed the huge budgets and knows how to make sure we get to things like a real hiring freeze, getting healthcare costs under control, and really demanding more efficiency and innovation in government. And then third, we need to make sure that we continue to invest in things that will make the economy grow. Quality of life and our educational system, which I have the most comprehensive detailed plans for as well.
You can't do it alone, and it may require more even than Washington. That is to say, you need the business community to really support. Some might say that under the most recent, the current administration, there hasn't been a great relationship between the mayor and the business community in New York. What can you do to enlist the business community to help you get done what needs doing?
Well, I think that's a diplomatic way of putting it. And let's be clear, I think the current mayor has demonized and divided New York. A hallmark of my career, whether it's working under Mayor Bloomberg or all 8 years in the Obama cabinet, is being able to build public-private partnerships. Look, I grew up in this city in the 1970s and 80s. My dad is an immigrant who came to New York, started a company, and ran it his entire life. This is personal to me. I saw what New York City looked like in the 70s and 80s. Watching the Bronx burn actually lit a fire in me to go to work in public service. I came back after school and started rebuilding neighborhoods across New York City. I fundamentally understand that we need everyone at the table if we're going to rebuild this city. We need a mayor for all New Yorkers, not someone who's going to demonize and divide us. So that's who I am. That's who I've always been in my career. And it's personal to me, David.
So Sean, I said, put aside the messy little details about getting nominated and elected. Let's talk about those details just for a moment. What's it like campaigning in a virtual world, a world of social distancing? How do you do that?
Well, look, you got to be safe first and foremost. Some of my fellow candidates haven't been doing that and have come down with COVID. We need to make sure safety is first. Second of all, we need to really adapt our strategies to be able to reach folks. You know, one of the things about Zoom is you can get up to a lot of forums all over the city and draw New Yorkers independent of where you are. So it has its downsides, but it definitely has its upsides in being able to reach people effectively. The last thing I would just say is it's going to take a team that really understands how to do this. And one of the things I'm proudest of, we've built the most talented team in the entire race. We've hired real talent coming directly off the Biden campaign who understand what it means to use the latest tools with texting and other technology to do distributed organizing and reach folks. You really have to be nimble and understand today's technology to be able to win a race like this. That's the team that we've built.
Okay, thank you so much for joining us today. Really appreciate it. It's Sean Donovan. He's Democratic candidate for mayor of the city of New York. Coming up, a new era at the WTO. The World Trade Organization gets its first female and African leader. We discuss the tough job ahead for the former Nigerian finance minister with Rufus Yerksa. He's former deputy director of the WTO. That's next on Balance of Power on Bloomberg Television and Radio.
our generation's biggest problem.
Climate change is happening.
And the world's most innovative solutions.
Transport, industry, buildings, electricity, all of those things.
Everything you need to know about our changing environment, the politics of global warming.
We can and we will deal with climate change.
In the fight against climate change, Bloomberg Green has you covered.
This is Balance of Power on Bloomberg Television and Radio. I'm David Weston. The World Trade Organization has a new Director General, Ngozi Okonjo-Iweala. For a perspective on what this means for the organization, we welcome now Rufus Yerxa, who served as WTO Deputy Director General. He is now President of the National Foreign Trade Council. So, Mr. Ambassador, thank you for being here. It strikes me that, among other things, this is the first African and the first woman to head the WTO. What does that mean?
Well, thank you, David. Good to be with you. Yeah, it is. Obviously, she's an historic choice. You know, the Africans were not large participants in the global trading system really until about the 1990s or early 2000s. And obviously, Nigeria, being the biggest economy in Africa, you know, is very proud of this choice. But, you know, I think she's a groundbreaker in a lot of respects. She's a woman, obviously, and that's the first. There's been one woman deputy, but never a director general. And she brings with her both the experience of, you know, the development economist working a long career in the World Bank, who understands the developing world, but also, you know, somebody who understands major issues of trade and finance very well. She's a tough cookie. She's a very, very strong personality and somebody who I think will play effectively in the role, which is to, you know, push the members towards getting deals and getting movement in what is vitally needed, is to move the WTO system forward.
Well, exactly. Talk about how tough a cookie she needs to be, because there were issues raised, certainly by the Trump administration, but you said it wasn't unique to the Trump administration about the need for reform. What sorts of reform does she need to get done? Can she do it?
Yeah, I mean, obviously, she's got to try to find an agenda that is going to work for, you know, the vast majority of the key players in the system, and you know that obviously includes the U.S. and Europe and Japan and others. But also, how do you deal with China? Because many of the pressures will come to kind of reform the rules to make it the WTO more relevant with respect to some of China's practices. But I see other big challenges for the system that she'll have to take on besides that one, which is a significant one. Obviously, digital trade and the digital economy, global trade and health, because, you know, the effects of the pandemic and the kinds of measures countries put into place that were probably counterproductive, but how do we have better cooperation to deal with global health problems? And a big one is climate change, David, because now, you know, the Biden administration is going to want to push forward with the Paris Agreement. A number of countries want to figure out how you develop trading rules that make the WTO system able to approve some kinds of, you know, border adjustments for carbon tax systems, which are probably going to come eventually as a part of how we move to a lower carbon economy. So that's going to be a big challenge for the system.
She comes in at a time when, as you say, there are real shifts going on in world trade. And one of them we saw just this week, where the European Union Statistics Organization, Eurostat, reported that for the first time, China now has replaced the United States as the largest trading partner with Europe. What is the significance of that, and particularly for the Biden administration as they come in to try to implement their own trade policy?
Yeah, you know, you're starting to see now a lot of analysis of how badly Trump's China strategy really backfired on him. I mean, not only is our overall trade deficit much bigger than before he took office, but our exports to China actually are down significantly from before the trade wars. China has recovered and unfortunately is proving itself more likely, absent some new strategy by the Biden administration, to become a more powerful force in world trade than the U.S. They have a new trading arrangement with Asia, as you know, this RCEP agreement. They even have this new investment deal with the EU. And the effect of that would be to significantly endanger our global lead on innovation and technology development, if we're not able to push back now and come up with a new approach that puts the U.S. back in the driver's seat. And, you know, protectionism, the old Trump trade war approach, is simply not going to give us the answers we need to compete in the world and to lead the WTO system. They're going to have to figure out how to make peace with our best allies and create a new alliance of what I would call the democratically elected market economies to push back on China and start insisting on changes in China's practices, and for the U.S. to be able to preserve its technological and innovative edges. We have to run faster than the Chinese here at home.
So, Rufus, you just put your finger on the two that I've heard most out of the new administration, which is unfair practices and technology. But does it make it more difficult for the Biden administration to bring the Europeans on board if, in fact, their largest trading partner now is China, not the United States?
Well, we can still do a lot to strengthen our relationship with Europe and to reverse that situation. We ought to get beyond some of the old disputes we've had festering between the U.S. and Europeans for decades, like the Airbus-Boeing dispute, you know, like disputes over agriculture and other things, and move towards a more coordinated approach, not just with the Europeans, with Japan, with other democratically elected market economies in Asia and in Latin America. And if we do that, I think you know, the U.S. still has very robust trade and investment flows with Europe. But the Europeans lost a lot of confidence in the U.S. during the Trump era and are, you know, they don't want to be in a situation where they are going to face unpredictable and sudden kinds of actions like Trump was taking against them. And Biden is going to have to work on how we give them those assurances while at the same time addressing some of our concerns about them.
Right. Thank you so much, Rufus. Always great to have you with us. That's Rufus Yerxa. He's former Deputy Director General of the WTO, and now he's President of the National Foreign Trade Council. Coming up, Wall Street's commitment to diversity. Goldman Sachs, just the latest lender to throw its weight behind HBCUs. Asahi Pompey, she is Goldman Sachs Global Head of Corporate Engagement and Goldman Sachs Foundation President, joins us with more. This is Balance of Power on Bloomberg TV and radio.
Valuations, particularly, you know, sort of the technology landscape, have gotten to some pretty extraordinary levels. So I think it's not a surprise. I don't think it's any indication of the beginning of the end, but I do think markets don't like uncertainty.
This is Balance of Power on Bloomberg Television and Radio. I'm David Weston. President Biden has made further progress in eliminating racial injustice a priority, seeking to build on the civil rights progress of the 1960s.
They saw it happen. And so it generated the Voting Rights Act, it generated the Civil Rights Act, and he called it the Second Emancipation. We have a chance now a chance now to make significant change in racial disparities.
Wall Street is seeking to help in the quest for racial justice. And our colleague, Sonali Basak, is here now with one of the Wall Street executives who is leading the effort. Sonali?
Thank you, David, and thank you to Asahi Pompey, Goldman Sachs' Global Head of Corporate Engagement. Asahi, I know we're here to talk today about your Goldman's $25 million commitment to historically black colleges, but I do want to set the stage here nationally a little bit, because we have President Joe Biden and his commitment towards racial equality. How is that? Do you believe that it in some way is pushing the financial industry forward in a faster way?
You know, I certainly think it's pushing the financial industry in a faster way. I think there is a fundamental realization that, you know, racial equity can no longer wait. As I was coming up in the industry, Sonali, very often the question would be, where's the pipeline? You know, show me the black talent and I'll hire them. I think there's a fundamental shift. There's an understanding that the talent is there. HBCUs for generations have been producing titans of industry. Vice President Biden, Keisha Lance Bottoms, Spike Lee, and the list goes on. And it's a matter of tapping into that talent and really widening our aperture.
Well, part of this is interestingly structured, too. You're having Goldman's young bankers teaching a class, really. You're teaching financial literacy at historically black colleges. How do you expect that to make that pipeline a bit bigger?
Well, in terms of the program, it's a $25 million commitment to historically black colleges and universities and their students. And so the program is a 4-month immersive, intensive program on finance fundamentals, where these 125 students will learn how to value a company. How do you compare companies? How do you do a model? They'll get a front row seat with the head of investment banking, the head of sales and trading, the head of research. And in addition, Sonali, as you mentioned, they'll also be paired with an analyst that currently works at Goldman Sachs to really tell them the ins and outs of what it's really like to work on Wall Street.
So a lot of this comes down to the pipeline. We still hear after so long that people are having a hard time with that pipeline. Do you think that this could become a matter of law at some point, that there will be quotas here if the industry doesn't move fast enough to fix this issue?
You know, I think, you know, corporations are making aspirational goals and they're publishing those goals. So it's a matter of setting aspirational goals around hiring and recruiting, being public and transparent around what those goals are, and then driving towards execution to really deliver on that. That's the formula that we've been following at Goldman Sachs. In particular, in terms of our recruiting from HBCUs, we've set a goal of doubling the number of HBCU analysts that we hire by 2025. And so you'll see that happening more and more, which is set a goal, publish it, and diligently hold yourself accountable to really meeting that goal. Sonali, I really think will change the trajectory and ultimately, hopefully, the face of Wall Street.
You know, and the numbers on Wall Street are still pretty stark here. I mean, how much further can you go this year?
You know, I think there's significantly more than we can go. I'll tell you, share with you how I started on Wall Street. I got an internship at a small investment bank, you know, several years ago, and I really didn't see Wall Street as a place for me. I really didn't think as a poli-sci major, you know, I thought you had to be a finance major to really work on Wall Street. And so part of this is around showing what's possible, that it's not just Howard or Harvard, it's Howard and Harvard. It's Spelman and Smith in terms of our hiring. And I think if you see that and drive that with consistent effort over time, it could really make a significant difference in catalyzing change on the street.
And we just have a few more seconds here, Sahi. What was the one thing you would want to see from President Joe Biden on his equity efforts?
You know, I think it's about sustaining the effort, Sonali. Things cannot be episodic. This cannot be a false dawn. We've got to make sure that the effort is sustained and it's a multi-year commitment in order to really see progress.
That was Asahi Pompey of Goldman Sachs, the Global Head of Corporate Engagement. Thank you for joining us. And David, back to you.
Thank you so much to our colleague, Sonali Basak, speaking there with Asahi Pompey from Goldman Sachs with their remarkable announcement of $25 million now to be committed to historically black colleges and universities across the country, something that, frankly, President Trump's administration has also endorsed and backed, but now they're moving forward robustly. And, of course, we have a vice president now in Kamala Harris who graduated from one of those colleges. So it was great to have Asahi Pompey with us today. Coming up on Balance of Power, we're going to continue on Bloomberg Radio over our second hour We're going to talk to former Secretary of Agriculture and Governor of Nebraska, Mike Johans, about the Biden approach to agriculture. It turns out that the farmers earned more money last year than they had done in 7 years, but it looks like they're not going to get back to that level until 2030. We'll also ask him some about the possible effect on the farmers, on agriculture, of what we're seeing with the severe cold in Texas. This is Balance of Power on Bloomberg Television and on radio.
I feel we have a very good chance to not only have positive growth, but perhaps a somewhat more encouraging positive growth.
The rebound in the second and third quarter will be quite strong because the expectation is that the vaccine will help clear the way to less restrictive lockdown.
We are going to have a recovery, but it's going to be an uneven recovery.
Of course, it will have direct impact on our growth forecast, and it will be very difficult to reach 6% of growth.
You're going to get a roaring 20s type of recovery and a boom period.
We are certainly seeing ourselves towards the second quarter being in almost opening the economy as much as one can.
We should not be too quick to cut back on the expansionary fiscal policy.
We'll get there. The question is not a question of if, it's a question of more when.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials,